Um, okay, so I don't really have a format for this. I didn't really prepare anything specifically. It's going to be kind of informal. I just want to go through a lot of stuff about my portfolio, some of my write-ups, my recent write-ups, some which have gone, stocks have performed really well, some have not performed so well, which ones I'm holding on to, which ones I've already dumped, why I dumped them, when I got out of them, why I got out of them, why I'm still holding on to stocks like Upstart and Celsius and DermTech and so forth. So I'm going to share my screen because I doubt you guys care about looking at me. So this is my current portfolio, 28 stocks. I actually ran the numbers the other day. Let me see if I can pull that up real quick. I posted it in my StockTwits room, so it should still be there. Okay, so 28 stocks. Largest market cap is 61.9 billion, which I believe is CrowdStrike. Smallest market cap is going to be 400 million, which is ClearPoint. Average market cap in my portfolio was 15.1 billion. This was as of yesterday morning. So it's probably still pretty close to that because we got a sell-off at the end of yesterday, and then today looks like a decent start to the morning. And then weighted average market cap, which is really the number that I pay attention to, is 9.8 billion. And then if I actually did my portfolio from largest to smallest, it would look like this. So Upstart is still my largest holding. Celsius is number 2. DermTech is number 3. Stem was number 4 yesterday, but it's actually dropped into 5. ClearPoint is number 4 today. Stem is number 5. SoFi is dropped down to 6. And then you got like Desktop Metal and Shockwave are, kind of tied for that, 7th spot. And then you get into Zim Shipping, which I want to talk about on this webinar today. This is a stock that I've been in for a few months. I haven't talked about it yet on Substack. My StockTwits room people know about it. Very exciting company, shipping company, but there's a little bit more to the story than just being a shipping company. So after that, then I got CrowdStrike, and then Danimer Scientific, MP Materials, HiMax, semi company out of Taiwan, and then App, Zoom Info, Digital Ocean, and then you get into like some names: TransMedics, Zillow, Love, which is a kind of a DTC sofa company. They make those big, I don't think they're really beanbag chairs, but and then ZipRecruiter, kind of the idea behind this one, which I'll talk about a little bit later, is valuation's attractive, growth is decent, margins are phenomenal, and now that we have some of these rent and mortgage moratoriums ending, I think and there's a lot of job openings out there. I believe somewhere 10 or 11 million job openings. I think ZipRecruiter is going to play an important part in helping to fill some of those roles. And then these are some new names I've added where, some of them have had a decent run. Valuations are a little iffy on a couple of them, but I'm prepared, basically starting small positions. And if the stocks pull back, I would add. So Palantir is PLTR. DLO is international payments company called DLocal. Coupang is a new one for me. This is kind of like the Amazon of South Korea. Recent IPO earlier this year, stocks down like 50% from the IPO or from the highs after the IPO. I just added this one the other day, basically trying to pick the bottom with the tight stop loss. Roku, I'll show you why I jumped into this one, basically off of a trend line bounce. Expedia. So Roku and Expedia are sort of like the opposite of each other. If this pandemic finally ends, Expedia would probably do really well. If the pandemic continues to linger, I would expect Roku to to do well, sort of be a hedge against Expedia. But hopefully they can both do well. Sentinel One, which is a recent cybersecurity IPO, obviously a pretty small position. And then AI is a company called C3 AI, doing basically enterprise AI software run by a guy named Tom Siebel, who was a kind of a .com wonder kid. I think because that was 20 years ago, so he was obviously a little bit younger back then. I think he's maybe in his 70s now, so maybe back in his 50s when he was running Siebel Systems. So that's my portfolio from largest to smallest. Upstart is still about a 20% position for me. It was about 24% going into their Q2 earnings report. Obviously, they knocked the cover off the ball. That's an understatement. This has by far and away been my biggest winner this year, and I think most people that own it would probably say the same thing. Stock's up over 400% year to date. It's actually a 10 bagger if you owned it, if you got IPO shares. So company came public in December. They priced the offering at $20. So the range was actually 20 to 22. So they actually priced it at the low end of the range because there really wasn't much demand, because they came public around the same time, if not the same week, as Airbnb and DoorDash. So everyone was focused on those two. Nobody was paying attention to Upstart. But in all fairness, Upstart had been forecasting about $350 million in revenues for 2021. So it didn't look like they were going to have this exponential growth. And they came into the year with a lot of customer concentration risk, only 10 bank partners, only in personal lending. But over the last 9 months, that story has really changed, where now they have 25 bank partners, a lot less customer concentration risk. They've done a couple acquisitions. Well, they've done one acquisition of a company called Prodigy. They've launched in auto loans. There's thoughts that they're going to get into mortgages now. If you go to their careers page, it's actually been taken down, which makes me wonder if they filled the role or not. But up until a few days ago, there was a listing, a job listing on their careers page for a product manager for mortgages. So, you're starting to see some, if you connect the dots here, there is a thought that they might be getting into mortgages at some point in the near future. That could be 6 months, 12 months. I don't know. Obviously, mortgages is a massive market, way bigger than personal loans or auto loans. So, there's a lot of optionality with Upstart right now. Dave Gerard, the CEO, was on Kramer last night. If you haven't watched the interview, it is right here. I will post this link in the chat. I think I can post in the chat. So hopefully you guys can see that. It's also on my Twitter page. And if you just go to cnbc.com, you should be able to find it there. But I mean, it's a 6-minute interview. He didn't say anything that we didn't know already. He talked about how important AI is going to be going forward, how it can help to undiscriminate the underwriting process, where a lot of minorities, Black people, etc., are left out of the credit system. And FICO, like Dave explains, FICO was created 30 years ago. That's obviously become outdated because there's so much data out there now that can really help companies like Upstart determine someone's credit worthiness more than just a 3-digit FICO score. So, they've added 15 bank partners over the last 8 months. So, about 2 per month if they continue on that pace. And I think there's a chance that that pace accelerates. But if they continue on that pace, that takes them to, let's say, 35 by the end of this year. But Upstart did a couple announcements. I think it was early Q2 maybe, where they announced a partnership with a company called Nextsoft, which is a technology company that should help them onboard these bank partners faster. And then they also announced a strategic partnership with NAFCU, which is the, I want to say, National Association for Credit Unions, Federal Credit Unions, I think. And there's literally thousands of credit unions around the country. And then on top of that, there's thousands of, commercial banks, whether you're talking the large mega banks, the national banks like Bank America, Citigroup, et cetera, or you have the regional banks, and then you have the community banks, and then under that you have the credit unions, I suppose. So, different layers. Whether or not that top layer, the mega banks, ever works with a company like Upstart, I don't know. Maybe they try to develop their own in-house proprietary technology and models, or maybe not. Maybe they don't want to spend millions and millions of dollars and many, many months or even years, trying to catch up to Upstart if it's only going to be them using it. If they already have the customer base, I would argue that it makes more sense to partner with Upstart, because if Upstart's able to determine someone's credit worthiness and do a better job of anticipating risks and defaults and loan losses, etc., then any bank of any size can essentially underwrite more loans and lose less money on those loans. And, the important part that keeps this flywheel going is these institutional partners. So Upstart, 8 months ago, I believe, when they went public, they talked about 100 institutional partners that were buying these loans back from their bank partners, because sometimes these banks don't want to keep all of the loans on their balance sheet. They want to sell it off to institutional partners, which, that can be mutual funds, that can be hedge funds, that can be credit funds, that can be endowments, foundation, pension plans. I mean, there are a lot of different players in that institutional market, but that number has grown from 100 to 150. So approximately 20 to 25% of all loans that are underwritten by the bank partners are kept by the bank partners. The other 75 to 80% are sold off to these institutional partners. And it's clear that they, I don't want to say prefer, maybe prefer is the right word, but it does seem like they prefer these AI approved loans, because these AI approved loans, so far, if you look at the data from Kroll Bond Rating Agency, Upstart's loans have a lower default rate than some of their competitors. So it does appear that the AI is working. It's better than FICO. When Upstart announced their Q2 earnings, Dave, or the CFO, I forget who it was on the call, said that at least 2 of their bank partners are dropping the FICO scores from their models because the AI is so much better. These models that have 1,600 data points or variables are just that much better than FICO score. So in terms of Upstart, I mean, we can look at the chart real quick. For anyone that owns the stock, you know what I'm talking about. It's been just a massive winner this year. Shrink this down. Get this out of the way. So if we remember, I did my write-up back in December when the stock was back here in like the the mid 30s. I didn't catch it in the 20s. I wish I had. I caught it in the mid 30s. I think it was maybe at 38 when I did my write-up. And at the time, I actually thought that I was chasing the stock a little bit, only because it almost doubled since the IPO. And, lo and behold, here you go. I mean, this thing's just been a rocket ship. So right in here, this big spike is when we got the Q4 earnings, when they raised guidance from 350 to 500. And then you can see the stock pulled back. And then when did we get Q1 earnings? I guess this is when we got Q1 earnings, right in here. So you saw that big rip, right? I mean, it was trading right around 82 when they reported Q1 earnings, and then it basically went up like 3x over the next week. And then if anyone remembers, we got up to about 191 here, and then everyone started focusing on that the 6-month lockup expiration. So you saw a big sell-off down almost, so 108, 109. This is when I loaded up again, and I took a 24% position coming into Q2 earnings. And, I thought maybe they would raise guidance, because right here, so they raised guidance from 350 to 500 here, from 500 to 600 here, and then from 600 to 750 here. Massive gap up, and it's continued to rally, hold up very well. We got a little bit of a pullback and then ripped higher, and now we kind of seem to be settling into that 215 area. But we've already gotten through lockup expiration. You can see, there was massive volume here. Volumes tailed off, but that's a good sign. I mean, that means that there's really no one's really taking profits in here. So I don't mind that volume is trailing off. MACD looks good. RSI is pulled back a little bit, but still very strong. So if we look at what drove that big gap up, so I mean the numbers here are just freaking ridiculous. And you can find this report. So I didn't send out any updates this quarter on Substack. It was just overwhelming how many write-ups I would have had to do to try to kind of keep up. So I just figured doing this long webinar, which is probably going to be 2 hours to be honest, but obviously I'll post it to YouTube. I'll send it out to everyone on Substack, and if you want to watch it in 30-minute bites, obviously that's up to you, or 2 hours, whatever this ends up being. So I'm going to go through some of these stocks in as much detail as possible. This is just the first one since it's my biggest holding in my favorite company right now. So total revenue, if I remember correctly, I want to say that they were looking for 165. I forget the exact estimate. Obviously, they beat the number. I mean, blew out the number. I want to say by like 25 to 30%. I don't look so much at the increase over last year because they've already talked about how revenues were really depressed last year during the pandemic because banks didn't want to do any lending because they just, with the COVID and people losing their jobs, it was just way too risky. So this 1,000% increase is a little misleading. I think the number that does hold some water, and I don't know if it's in here or not, was the revenue growth just from last quarter. So if you look at Q1 for Upstart, so Q1 121. So just some quick math. 194 minus 121 divided by 121. Is that right? Was it really that much? Was that 60%? So 60% quarter on quarter growth is just insane. That's just, I was thinking, I don't know why I had 40% in my head. Maybe that's what Celsius did. I think that was Celsius. So 60% Q on Q, they call it sequential. Just a monster number. I mean, everywhere you look in here, it's just huge beats, huge numbers, raised guidance, contribution margins are going higher, conversion rates are going higher, EBITDA is going higher. I think they're actually being conservative on guidance. They probably, I mean, they've already proven, they already have a track record right now, 3 quarters in a row, they've beat and raised. I gotta believe they probably left some juice in the tank here. So when they're saying 750 million, there's maybe a good shot that we see more than that. So, I'm kind of guessing this year we probably end up, and we're not going to know this until 2022 when they report their full 2021 numbers, but we could easily see 800, 850. I mean, 900 would probably surprise me, but I think 750 is probably even sandbagging it a little bit. I think the most important thing is, it's like I said, the optionality. Started with personal loans, which is the hardest of all the credit markets or verticals because it's unsecured debt. You don't have any asset backing up or securing that loan, right? It's basically someone's personal credit worthiness and, their contract or loan agreement that they're going to pay it back. Versus you get into auto lending and home lending, you obviously have a significant asset to secure or back up those loans. So if they can prove that they have a better underwriting model in personal, then there's no reason for me to believe that they won't prove that again in auto lending and home lending. And obviously those markets are much, much bigger. So, what we don't know is when they give this guidance at 750, we don't really know how much of this is coming, or at least I haven't seen it broken out anywhere, how much of this is personal versus auto, and, when are we going to get home? My guess is we're not going to get home this year, or even if we did, we wouldn't see any revenue contribution from it. So, that would probably be a 2022 story. When I do my 3, 4, 5-year kind of financial forecasting models for all of my top holdings. I do have Upstart next year. I have them finishing this year, I think, at 850, and then I have them next year, I believe, doing about 1.5 billion. Although I could see them doing anywhere from like 1.4 to 1.9, to be honest. You know, because if they do 850 million this year with, you know, let's say the end of the year at 30 or 35 bank partners, you know, the majority of that revenue is going to come from a small number of bank partners. But as they start to onboard more, and then they start to scale up operations, and then they all started with personal, but then they start adding auto and home, you know, you're going to see way more revenue per customer. And if they can get to, you know, 50 or 60 bank partners, maybe by the end of next year, I mean, I could definitely see them doing, you know, 1.6 to even 2 billion next year. So there's just a lot of unknowns. You know, this is still such a new story. I feel like we're all kind of guessing what might happen, and we just really don't know right now. But I think it's a phenomenal company, huge upside, great management team. There's really just no reasons not to love this company and own some shares in your portfolio. I have trimmed back my position. So as you can imagine, if I went into Q2 earnings with a 24% position and it's up 80% since then, I had to trim it back. It just got way too big. So I think I did my first trim at 190, then 195, 200. And each one of those trims is like 3% of my overall position. So basically add it all up, and I'm back down to like a 20 or 21% position today, maybe just under 20. I'd have to double check. But call it 20. So that's Upstart. I think I pretty much covered everything. You know, you talk about valuation, and I think valuation is still very reasonable. So I put together this spreadsheet the other day called, it was originally called 100 growth stocks. Now it's 200 growth stocks, because there's obviously 200 plus companies on here. I don't own all these companies. I barely follow most of these companies, but I do see people talking about them on Twitter, so I wanted to include them for their sake. So I will drop this link into the chat box again. What I'll do is when I send out this recording to everybody on Substack, I will include all of the links that I'm posting into the chat right now, or at least discussing, so that, once again, this is on Twitter as well. So if you follow me on Twitter, or you're in my StockTwits room, you've seen this link before. But you can also sort this as well. You know, any of these columns are sortable. But if you go down to Upstart, and there's a limited number of columns here. I'm going to add a few more, probably like EBITDA, maybe net income, maybe free cash flow. But if you're talking growth stocks, and you're trying to compare different growth stocks in different industries, in, you know, kind of small cap, mid cap, large cap, some early stage, some more mature, it's really hard to come up with one metric that really acts as a good comp. The one that I have been leaning towards most recently is EV over GP, which is enterprise value over gross profit. I just feel like it's the most fair way. Now, obviously, there's so many other numbers and metrics that you should look at. You know, don't buy or sell a stock just based on this alone. You know, you do have to look at, you know, EBITDA and then net income, and what are they profitable now, or when will they be profitable? How much cash are they burning? How much cash do they have on the balance sheet? Are they going to have to raise capital, growth rates, and all of that stuff? So, but what I did here in this next column is, if you take this number and divide by the growth rate, you know, the expected growth rate for next year, you can basically see how much you're paying for that gross profit. So this is kind of a better way to compare these companies based on gross profit to what they're expected to do next year in growth. So the lower the number, the better. The higher the number, the more expensive. So if you actually sort this, you can see, and ignore the negative. So if they're negative, it means that revenue growth is actually going to be negative next year. But but you can see which stocks look the cheapest on this particular metric. Now, a lot of them are small cap, riskier companies that have performed pretty horrible year to date. So if you had just gone off these metrics for the last 6 months, you'd be underwater on most of these positions because the market right now has been really staying away from these types of companies, staying away from these money-losing, cash-burning, potentially, exciting companies in the future. But if they're losing money right now, the market's basically given them the middle finger for the last 6 months and really focused on the higher quality, larger, more profitable companies. And as you can see, what did I do? Some of these companies are looking pretty expensive. Now, Blend looks the worst because growth next year is supposed to be flat. So, you divide this number by 1% and you get a really, really big number. So I wouldn't necessarily, unless they're really, the numbers next year are flat, in which case I can't build a compelling case for owning the stock. But, like NVIDIA, for instance, if you look at NVIDIA on almost any metric, price to sales, price to earnings, it does look expensive, especially if growth next year is only supposed to be, 10, 11%. But NVIDIA has been one of the best performing stocks this year. So, a lot of the stocks that have looked expensive, Bill, CrowdStrike, Cloudflare, those stocks have all done really well this year. So, but okay, so back to alphabetical order. So where's Upstart? Here we go. So now I am using my own numbers for every single stock on this spreadsheet except Celsius and DermTech. I use the exact data that was in Ticker. So ticker.com, TIKR. That's where I get most of my data from. I also use Koifin. So 99.9% of all the data on this spreadsheet is exactly from Ticker. The only two where I used my own numbers were Upstart and Celsius, because I know these companies as well, if not better than the analysts. So I would rather use my own numbers to give me some guidance. So I actually used 800 here and 1.4 billion for next year. So I'm actually being kind of conservative. And if you look right now, if they did 800 million this year, it would represent 242% year-over-year growth. So the stock's only trading at 21.6 times gross profit. Look at some of these other companies. Now, Stem's going to look a lot cheaper next year because they're going to see this massive growth. But Shop. So Shopify is trading at 70 times gross profit, 50 times next year's gross profit. So, I don't know if there's another stock in the universe that is going to give you this kind of growth and trading at this much of a discount. This is a significant discount compared to other high growth companies. And then you look at the gross margins and they're just freaking ridiculous. So, and if they do 1.4 bill next year off of 800 mil this year, you're looking at 75% growth, which would take us to 12 times next year's gross profit, which is just laughable. And like I said, 1.4 bill, if you stick in 2 bill, now you're talking single digits EV over gross profit, which is just insane. So this is why Upstart continues to be my largest position. This is why I am trimming a little bit, but holding on to a large chunk of my shares, because I still think this stock is very, very undervalued. And there's a good chance that this number right here, this 1.4 billion, doesn't even include the potential of going into home loans. So, okay. So I can't believe I just talked about Upstart for half an hour. Holy shit. So as you can tell, it's my favorite stock, and now you know why. And if you didn't know why already, then you haven't been paying attention to me for the last 6 months. So let's move on. My next largest holding and favorite stock right now is Celsius. Let's look at the chart real quick. So once again, this has been a really strong stock for the majority of this year. It's been volatile, back here. When was this? May 11th. I forget. I guess this was just a big growth sell-off right here. And then this might have coincided with, trying to think, yeah, this was probably Q1 earnings. So this is probably when they reported Q1 earnings, beat estimates. Now they don't provide any guidance, so we're sort of on our own to do that ourselves. But with Celsius, there are two main data points that you can look at to try to determine, where the revenues might come in for the quarter, and that's going to be the Nielsen scan data, which is tough to get your hands on. I have a couple contacts in the beverage industry. Sometimes they give it to me, sometimes they don't. Usually I have to beg pretty hard. I'm working on getting the most recent Nielsen scan data, which would be for the second 2 weeks of July. So I have the first 2 weeks of July, which is the first month in Q3, and that was 195% year over year. But Celsius started doing a lot of influencer marketing at the end of July, mostly through Instagram and YouTube. So I'm hoping that we see even a bigger bump for the last 2 weeks of July because of that influencer marketing. And if you don't know what I'm talking about, I suggest you follow Celsius on Instagram, and you'll see how many, models, celebrities, athletes, UFC fighters, bodybuilders, surfers, like they're really getting their brand out there with a lot of these people. And I think that we're going to see the impact of that over the next couple quarters at the cash register and then online. So the stock ripped after Q1 earnings, and then unfortunately we hit a new all-time high here, and then we got a stock offering. So we still don't know exactly why we got a stock offering. They priced it at $62. Some insiders were selling, but the insiders that were selling were really the insiders that have been in this company since the very beginning, or at least 10 years. Most two of them are, I believe they're both billionaires. And they think they only sold maybe 10 or 15% of their stake. So, just like we all trim our portfolios, they were basically just trimming their positions. And most of them probably had a cost basis of literally under $1. That's where this stock was trading 10 years ago. So I don't blame them. I think this was a pretty big overreaction. It's unfortunate they priced it this low. I'm surprised they didn't price it in the mid 60s, but unfortunately, when they were probably talking about doing the offering, the stock was probably trading in the mid 60s. So they probably gave it a small discount. They didn't know, that a few days before they priced the offering, the stock was going to rally an extra 20%. So, you got the offering at 62, which basically just, took you back a week and a half. Anyone that chased the stock up here was obviously pretty pissed. I think most of us probably had a much lower cost basis than 62. So most of us were still in the green. And then over the last couple months, we've seen some choppiness. We've seen some bounces here off of this trend line, which is nice to see. That's obviously acting as support. If we got a pullback here, this is where I would look to, get aggressive again on adding, is right on this trend line. So they reported Q2 earnings somewhere in here. The stock actually sold, I think maybe it was right around here, because the stock actually sold off after that. And I'm not 100, I have some suspicions why. Earnings were fine. They beat estimates by, I believe, 22%. So they came in at 65 million. The street estimates were 53 million. So if you do the math, it's a 22% beat. So revenue in North America, revenues were up 117% year over year. In North America, where do they break it out? Oh yeah, right underneath. So North America was up 150%, 157% year over year. International was up 25%. So international is the big laggard. For North America, we couldn't come up with that exact number ahead of time, but we had a pretty good idea because the Nielsen scan data for all of Q2 was around 195%. And the stack line data, which tracks Amazon, was up about, I forget the exact number. I believe Stackline was showing 133% for the first 2 weeks of July. I don't remember if it was 133% for all of Q2, but I do wonder if people were expecting a bigger number. I thought it was possible that we might see 70 million, but the part that, the disappointing part is it's still the lack of inventory, and their ability to get product onto the shelves and keep it on the shelves, because, I've become obviously a big advocate for this company. People on Twitter know that. I'm constantly getting messages and people tweeting at me with pictures of their local supermarkets or convenience store or Costco, Target, Kroger, Walmart, Speedway. I mean, Celsius is in all of them. And there's a lot of empty shelves. And I don't know how long that's going to persist. Celsius did announce that they're up to, I think it's, let me just see how many DSD partners, I forget. Where is it? Where's the number? Huh. Unless it was up here. So I'm looking for the DSD number, how many DSD partners they have. I think it's in here somewhere. I know they said it on the call. I thought it was in here too. Oh, here we go. Maybe it's gonna be down here somewhere. Why can I not find this stupid number? Oh, well. I want to say it's like 180 to 200 DSD partners. So they did announce, though, that they're now in 100,000 locations. I believe it was 90,000 locations when they reported Q1. So they've added another 10,000 locations over the last 3 months. I assume we'll probably keep seeing numbers like that. That's probably going to slow down a little bit. There is still, here we go, 189. So 189 regional DSD partners. So once again, I know I've explained this before. So actually, I'm actually wearing a Celsius shirt right now, and I'm going to pop open a Celsius. This is cola. So they've been doing DSD for a while, but it was a much, much smaller part of their business. They were primarily DTR, which is a direct to retailer, which means the product actually goes to the retailer's warehouses or distribution centers, and then it has to get shipped from there to the store and then stocked by the employees. And DSD is, partners where, these are companies like Pepsi, Anheuser-Busch, that deliver the product right to the stores on their own trucks, and they stock the shelves. The challenge is, Celsius, when you're talking 150 to 200% year-over-year sales velocity, which is so much faster than their competitors, there is still a limit as to how often these DSD partners can get to these stores. Red Bull and Monster are growing like 20% year-over-year. So Celsius is growing 5 or 6 times faster, or actually more than that. I mean, if you look at 157% as their retail store year-over-year growth, they're growing at 7 or 8 times faster than their competitors. So that's the problem, is their sales velocity is so crazy right now that these DSD partners just can't get to the stores often enough to keep the shelves stocked. So, I think over time that'll probably work itself out. So as you can see here, these are some of the DSD partners they work with. Anheuser-Busch, I believe, is their biggest. I don't think Pepsi is that big, because I know Pepsi also distributes Bang. So if anyone knows of the brand Rockstar, it's a complete shit brand, shit product. I can't believe that they actually sold, but they had done an exclusive distribution deal with Pepsi years ago, and Pepsi actually had to buy them out for, I think, $3.8 billion a couple of years ago in order to basically like get out from underneath that exclusive contract so that they could start distributing other energy drink brands as well. And they picked up Bang. So when they picked up Bang, Bang said adios to their Anheuser-Busch partners. So then Anheuser-Busch, those partners came to Celsius, and that's how Celsius has been able to grow their DSD partners so fast over the last year, is because Bang left and went to Pepsi. And if anyone remembers, Bang has not been around that long. Like I want to say 4 years, maybe 5 years that I can remember. And they went from, I think, zero to $1 billion in sales in 3 or 4 years, working with those Anheuser-Busch partners. And now that Celsius has a chance to work with them, I think we're going to see that sort of growth as well. And then when you pair that with everything that Celsius is doing on the influencer side, I expect this growth to continue for a while. So I remain very, very bullish on the company. Nothing not to like right now. I mean, if the only holes you can really pick is, pick in the story is, or poke in the story, is their ability to keep the shelves stocked. But that's really just a, supply demand issue that will eventually balance itself out. The other exciting thing here is these coolers. So they placed an additional 300 coolers in Q2. They now have 500. What they're doing with these coolers is putting them in the key locations like convenience stores where you see a lot of the grab and go. People want to walk in, buy a couple things. They want a cold energy drink. They don't want a warm drink off the shelves, versus like grocery stores where people are buying, you're filling up a shopping cart with a whole bunch of crap, and then you're going home and putting everything in the fridge. Or you're going to Costco and you're buying a case or 2 cases of Celsius. You don't care if it's warm or not, or cold or not. So, but when you're talking grab and go locations like gas stations and convenience stores, and maybe even like we're talking CVS and Walgreens and those places, that's where you want to have these coolers. It's great branding, and then it obviously opens up the grab and go market. I was in CVS, my local CVS, a couple of days ago, and Celsius is now in the coolers. It's just a big, like unbranded cooler, but maybe at some point in the future you see Celsius coolers in certain CVS locations. So that's pretty much it with Celsius. I think the story's pretty obvious right now. Trying to think what else. That's pretty much it. So right now we're just waiting on July scan data from Nielsen and Stackline. Estimates, let's look at estimates real quick for Q3. So Q3, they're looking for 73 million, 98% year over year. I think that's probably going to end up being low, but like I said, until I see that Nielsen data and Stackline data, I have no way of really coming up with my own estimates. So we'll see. Full year numbers right now on Celsius. So analysts have actually raised this number significantly. I believe coming into the year, this number was under 200 million. Just a few weeks ago, it was up to about 225. So these estimates continue to go up for Celsius. The number that I have in my estimates is around 280 to 290, but we'll see. We have 2 more quarters to go. And what was I going to say? Forget. I don't think we're going to see any more stock offerings. They do have a pretty decent amount of cash on the balance sheet. So go to financials, balance sheet. Yeah, so they have 84 million of cash on the balance sheet, which should be enough. Let me just double check that. I think it's in here too. Here we go. Yeah, plenty of cash, 84 million. And it's a pretty significant amount of inventory too. So I don't think we're going to see another stock offering. If we did, hopefully it wouldn't be priced as low as 62. Where's the stock now? Wow, stock's up $2 today, so 74. Okay. Okay, I think that's pretty much it. I assume a lot of people watching this call webinar probably have some Celsius in their portfolio as well. So let's go to the next one, DermTech. Let's see, I didn't save Q2. Okay, so DermTech is definitely a little bit different situation than Upstart and Celsius. You know, Upstart and Celsius are both driving significant revenues now. They're profitable, and therefore the story is a little bit different. You know, their growth, their success, their stock performance is happening now because they're proving it through the fundamentals. Oh, I know what I want to say with Celsius. So I just want to go over valuation real quick. So some people will argue that Celsius is expensive. It's CPG, it's beverages. Why is it trading with a tech valuation? So 40 times this year's gross profits. Like, I get that's high for a beverage company, you know, with gross margins in the 46, 47% range. Okay. They're also going to grow this year at 114% if they hit 280. You know, if they hit 285, you know, 290. So, you know, this could be easily a 120% growth story, in which case, like, I don't think 38 times gross profit is expensive at all. You know, if you had a technology company, even with gross margins at 43%, and this is only because of freight. If you take out freight, it's in the 50s, but with freight, it's 43. If you had a tech company with 43% gross margins growing at 121%, it'd be trading at 80 times gross profit. And I know that the whole idea with software is it's recurring revenue, so you should be paying a higher multiple for recurring revenue. Okay, well, I would argue that energy drinks are recurring revenue in many ways too. I drink 2 or 3 of these a day. It basically replaces my coffee. I have one in the morning, one at lunch, and one before the gym. And I think a lot of other people are the exact same way. So, you know, I know it's not technically like recurring software revenue, but it's pretty close to recurring in my book. But I know they're never going to get credit for that. But if the company ends up doing 72% growth next year to 500 million, which is my estimate, we're talking 21 times gross profit. Not expensive. That is very, very, very cheap for this company with this kind of growth in a market that is in the tens of billions of dollars. And they have market share that is, I think their market share is up to like 1.5%. So they're still just a little peanut in a very, very large industry. So plenty of upside to go here. Now, if you want to compare that to Monster, I think I put Monster in here. Did I? I did not. Okay, so let's do some quick math. So I'll have to add that later. So Monster's enterprise value is 48 billion. Let's use next year's numbers to make this fair. So 48 billion divided by, so 9. So Monster is trading at 9 times next year's gross profit with 10% growth. Celsius, now granted it's my estimates, but Celsius is trading at 21 times next year's gross profit with 72% growth. So yes, they're trading at a multiple that's, let's call it 2.1 times higher. So, you know, a little bit more than double the multiple, but they're also growing 8 times faster. So I would argue that I don't think Celsius is overpriced at all. I think they're undervalued. I would argue that Monster is probably a little overvalued. That, you know, why are you paying 9 times gross profit for, you know, only 10% growth? So now it's, you know, they're more profitable. They've been around for 20 years. They do have, you know, gross margins are pretty similar, but, you know, just because Monster has so much more scale, you know, their operating margins do look a little bit better. So, I mean, I get they're going to get credit for that, but, you know, if you're looking at price to sales or price to gross profit, or EV to gross profit. Celsius still looks very cheap compared to Monster. So that's what I wanted to talk about. Okay, so DermTech, right? This is a different story than Upstart or Celsius. This is a 2022 story, in my opinion, and 2023, when you really start to see the monster growth kick in for this company. Now, growth is already happening, right? I mean, and this is why the stock is probably performing well the last few weeks since they reported. 267% year-over-year increase in billable sample volumes, and where's this sequential? And 21% sequential increase. So, if they can keep increasing this number by 25% quarter over quarter, they'll be just fine. Now, once again, and then you look at assay revenue, which is their PLA test, their pigmented lesion assay, 349 year over year. But once again, just like Upstart, just like Celsius, just like a lot of other stocks, business was very depressed in Q2 of last year. So comparing year over year is a little misleading. I do think that the sequential numbers are a little bit more relevant right now. We saw 60% sequential for Upstart. Celsius, we didn't do that. Wrap up Celsius with this last thing. So if you look at quarter over quarter on Celsius, so 65. I can do this in my head, right? So 40%. Yeah, so this was the 40% that I was thinking. Oh, no, 30%, right? 15 divided by 50. Yeah, 30%. Okay. So Upstart was 60% quarter over quarter. Celsius was 30% quarter over quarter. One more thing I didn't mention was Celsius. So 65 million was probably a little disappointing to some. I thought some of us thought that they could do 70, but because of the let's call it inventory shortage in retail and certainly on Amazon, I think they left at least 5 million, maybe as much as 10 million on the table. So if they had not had inventory issues and supply shortages, and so many empty shelves and empty coolers and out of stocks on Amazon, which is sort of a good problem to have, I think they could have done at least 70, if not 75 million. And then we might be looking at an $85, $90 stock right now. I still think Celsius can go to 100 by end of year. So my price target for them by year end is like 90 to 100. So let's call it 95. Upstart, I really don't know where they end up this year. It's just been such a wild stock. My price target for next year on Upstart is 380 to 400. So, and I think that's very much within reach if they put up the numbers next year, at least 1.4, 1.5 billion. Okay, so DermTech. This year, they're going to end up doing probably around 13 million. I believe that was guidance. Let's see. Okay, so 11.5 to 13.5. So call it 12.5. Which is obviously pretty substantial revenue growth over last year. But 2022 is really the big year for growth, and two main reasons why. One is hopefully we're past the pandemic. It's very difficult for sales reps in the dermatology industry to get into dermatology offices and really present this solution, the patch, during a pandemic when they're not even allowed to be in those offices. So, I'm sure they were calling on these dermatologists, but it's just not the same when you can't do face-to-face meetings. So as we get through this pandemic, hopefully as the Delta variant subsides, I think we're going to see more dermatologists onboarded. We'll see more tests per dermatologist, because that's also going to be, as this pandemic subsides, that's when people will probably get back to seeing their specialists on a more frequent basis. That will create an opportunity for dermatologists to, get their patients using this patch for the first time. So, those are all important numbers to pay attention to going forward. The number of dermatologists that are onboarding, the number of tests per dermatologist, and both of those things I expect will pick up in 2022. And then on top of that, we're going to get the launch of Luminate. So Luminate, for anyone that doesn't know, the website is luminatedna.com. So I think this is going to, so it's sort of unclear right now. I don't know when we're going to get exactly more clarity. Like if you go to this website, I think it's going to be a DTC solution, but not completely DTC, meaning, direct to consumer. So I don't know yet if this patch is going to be covered by insurance. So it might be just pay out of pocket, but I don't know what the cost is going to be versus the PLA patch, which is around like $660, I think, or $650 now, and that will probably come down over time as well, especially as they get more pressure from insurance companies. So that's one of the big catalysts for DermTech going forward, is getting these big commercial payers, the insurance companies like a Cigna, United Health, getting those companies on board, supporting the PLA patch, supporting Luminate, supporting Carcinome when it comes out next year for basal and squamous cell cancer. So those are going to be the three products that are driving DermTech, into the future. Right now, we just have the PLA and the PLA Plus. So PLA Plus is the new PLA that has an extra indicator on there that makes the test or the patch even more sensitive and accurate, which decreases the negative, I forget what they call it. But Luminate. So I've heard them talk that you'll be able to get this through your dermatologist, but it also sounds like they're going to do DTC. They're also getting into telehealth. You can actually go, so DermTech has their own mobile app now, so you can actually go into the App Store and download the DermTech mobile app. And I believe that that's one way that they're going to push this Luminate product as well. So I don't know if you're going to take pictures with your phone of suspicious looking moles and send it to them, and they'll diagnose it and try to determine whether or not you're a candidate for the PLA patch, because the Luminate is really not to detect skin cancer. It's to try to predict if you might develop skin cancer. At least that's how I interpret it, where they are analyzing your the DNA in your skin to try to see if you have any early indicators that you might be someone that could develop skin cancer at some point, because it's all about trying to catch skin cancer as early as possible and get it removed, remediated, before it develops into something that could be life-threatening. So it's interesting. I mean, if you go to, I think I have it saved, investor presentation. So if you go to the DermTech investor presentation, this might be from Q1. Oh, it's Q2. Here we go. So we've all been talking about PLA for the last 6 months, because that's the only product that's on the market right now. But if you look at this opportunity, they actually think and that's, this is the one that's obviously to try to catch melanoma. They think this is the smallest. So they think Luminate is actually the biggest opportunity. So whether that is through dermatologists, through your primary care physician, DTC, all of the above, they think giving individuals the power to have their skin analyzed is really how they're going to be making their money, what's going to drive this growth going forward. So I'm excited. This product is supposed to launch, I believe, in Q4. So hopefully they launch it in Q4, and then when they report Q4 earnings in 2022, we start to see some of those revenues coming through, and we start to get some indications on, how much demand there might be for this product going forward. So that's why I'm still excited about DermTech. Let me see what analyst expectations are for next year. So 25 million for next year. They're still going to lose money. They still have like 250 million of cash on the balance sheet. If you look at these numbers, DermTech's obviously going to look really expensive this year because, we're still talking very small numbers. It starts to look more reasonable next year assuming they hit. So I have them at, so I guess I did tweak this number. I have them at 28.5 next year. I do think that 30 million next year could be in the cards if Luminate goes really well and we see continued traction in the PLA patches with more dermatologists coming on board. We could easily hit 30 million next year. So then you're talking 122% growth and 61 times gross profit. So once again, like for a company that's growing that fast, I don't think this is an unreasonable multiple to pay. So I would argue that this is probably cheap for a company that's growing this fast, because if Luminate and carcinoma and PLA go as well as we think they can, then when you start looking at 2023 numbers, you could be talking 50, 60 million. I mean, you could be talking about $100 million in revenue within the next 2 or 3 years. You start, if they're growing 50, 60%, you put a multiple on that and you're talking about a, $3 or $4 billion company. And right now you have an enterprise value of just 700. So, that's how I think DermTech could be a 3x, 4x type of performance company over the next 3 or 4 years. If we see this kind of growth continue from new product launches, more dermatologists using it, et cetera. So DermTech's my third largest position. So Upstart, I've been trimming a little bit, just because the position got too big. Celsius, I've trimmed a little bit in the 70s, only once again, because the position got too big. Celsius is probably around a 14 or 15% position right now. DermTech is probably around a 6 or 7% position. So I'm pretty overweight in my top 2 here. I would be adding to DermTech. I would probably adding here. I think, anywhere under 35, 36 is still a really attractive entry point. I mean, the stock's basically gone nowhere over the last 6 or 7 months. I did my write-up back in, I think it was late January, right around here. Stock ripped up to 84, which was ridiculous. Should not have been up there. And then pulled all the way back down to like 28, 29. And, now we're obviously kind of bouncing around here. I think, this 31.30 level has acted as support on several occasions. So, it seems like whenever we find this level, we seem to bounce off. One of these, I think right now we need to get above this like 38, 39 level, and then we can start to challenge the 48 level that we got to a couple months ago. So, I mean, I just personally, I just don't care what DermTech does right now. If it pulls back to 38, I'll probably add to my position. If we rip up to 48, I'll probably trim back to position and just, do a little bit of trading as we stay in this choppy zone. But I think in a couple of years, we're probably challenging these $84 highs. So this is most likely going to be a long-term hold for me. I don't see anything right now that would get me to sell it anytime soon. Okay, ClearPoint. Q2 earnings. So ClearPoint earnings were probably a little disappointing. Like DermTech, this is a 2022 story. So they were a little light on revenues, but once again, we're still sort of in a pandemic. Certain surgeries, procedures are not happening as quickly as they normally would if we were not in a pandemic. Certain numbers were up pretty significantly. Commercial sales are obviously going really well. So for anyone that's not familiar with ClearPoint, I did my write-up maybe 4 or 5 months ago. I forget where the stock was trading. Let's see. Yeah, I think I did it in March, somewhere in here, maybe. So maybe in the 18, 19, 20 range. Right now looks like we're about 18, 13. So, this is some pretty significant consolidation. I mean, I can't really say whether the stock is undervalued or overvalued right now, because I think this is really a 2022 story, like I said. So if you look at estimates, so 16 million this year, 26 million next year. But what's interesting is, let's see if I can find it on Twitter. I think I saved it. Hold on. Let me just look through my images real quick. So one of the analysts, and there's only a few analysts that cover ClearPoint, but one of the analysts came out the other day and raised his numbers for the next couple years. Give me a minute. Here we go. So this is from B. Riley Securities, and they have I believe, a $38 price target. Yeah, B. Riley's at 38. So due to CLPT's 2021 Q2 print, our 2021-2023 top line adjusted EPS are going from, so these are revenue numbers. So for 2021, they're increasing from 16.7 million to 16.7 million. Okay, not a big deal. 2022, they are increasing from 31.9 million to 32.5 million. And for 2023, which we don't see yet on ticker, they're going from 57.3 million to 58.2. So 58.2 million. So 58.2 minus 32.5 divided by 32.5 gives you about 79%. So they're looking for revenue growth in 2023 of about close to 80%. Now, I'm not exactly sure where gross margins are going to be then, probably in the low to mid 70s. So if you take like 58 million times, let's call it 74%, get about 43 million of gross profit for a company that's growing at close to 80%. I mean, I don't know, 50 times gross profit, 60 times gross profit. That gets you up to like a $2.5 billion company in 2023. And right now we're looking at an enterprise value of under 400 million. So, that's one reason why I own this stock and why I'm not really worried about what growth happened, what growth looks like this year, because the bigger growth story for this company is really in 2022 and 2023, as we see their ClearPoint system, their guidance system, being used by neurosurgeons and neurologists for different procedures, DBS, implants, to help treat different diseases like Parkinson's, seizures, and then kind of like the biggest upside or optionality is going to come as a drug delivery system. So ClearPoint is enabling neurologists and neurosurgeons to see real-time MRI imaging, so they can deliver these drugs and gene therapies to different parts of the brain, but do it in a much more accurate and safe manner. And right now, I believe ClearPoint is up to like 30 different partners, maybe even more than that. So these are partners that are developing drugs for the brain that would be using ClearPoint's system to deliver those drugs. So if any of those drugs, and some of them are in trials now, if any of those drugs get approved, then each one of them provides significant upside for ClearPoint. So, biotech generally scares me because it's just so binary. You either get a big win or a big loss. I don't like that. just feels like gambling. But with ClearPoint and all of these different partners that are developing drug that would use their platform, you sort of get exposure to the biotech space without the risk of that binary outcome. So, let's say there's 30 drug partners developing drugs and 3 of them get approved. Each of those drugs could bring in 20, 30, 40, $50 million of revenue a year from hospitals and neurosurgeon departments using ClearPoint for the drug delivery. So I just think this is a really, really exciting company that I want to own it. So if this stock pulls back to the $16, $17 range, I would absolutely add more. It seems like this is kind of the, this is the floor you'd want to pay attention to, somewhere in this area here. Let's call it 16. So if we got anything back to this 16 level, I would probably load up again and then probably start trimming back, in the 20s. So I'd like to obviously see us, break through, these highs at some point in the next, 2 or 3 months. Whether or not we're going to get there with, Q3 earnings or Q4 earnings, I just don't know. I don't know if there's going to be enough growth rate now to drive the stock significantly higher, but I do think that when we get into next year and we start to see that big growth kick in, that's when the stock is going to really start ripping higher. And I would rather be in now, get in early with a low cost basis and be patient rather than chase it later in the 20s or 30s. So if you own the stock and you've owned it for the last 4 or 5 months, it's been a little frustrating, but I think when you start to dive in and understand the story, and obviously the analysts are pretty positive on it. B. Riley, if you search, I can probably include this this short write-up in the email that I send out with this video. I only have 1 page. I don't know how long the full write-up was, but this 1 page obviously includes some pretty significant information, including these new estimates for the next 3 years. So, but when you start to look at 2022, 2023, and then maybe even 2024, where even if growth slowed down from 80% to like 60%, you're still talking at, maybe 90, 95 million revenue with gross margins probably in the mid 70s. And that's probably conservative because if more of these drug partners are successful with their trials, I mean, ClearPoint could easily blow through 100 million in 2024. And now you're talking, a $3 billion company, maybe a $3.5 billion company. So it's one of my favorite stocks, and that's why it's a large position for me right now. Like if I'm being honest, I wish it was a smaller position this year, and I wish I'd had more money in some of these, the better performing stocks in my portfolio, or some of these slower growth but higher margin companies that I own, like a Zoom Info, which have done really well this year, or CrowdStrike or Shockwave. So, okay. So if anyone has any questions on any of these stocks, feel free to email me or shoot me a message on Twitter, and I'll try to respond. Stem, I'm not going to dig in too much with this one. This was actually my most recent write-up. So everyone watching this has probably read my write-up on Stem. And then I did an interview with the CEO, John Carrington, just a couple days ago. So if you go to my YouTube channel, and I actually created a link to make it easy, youtube.jonalupton.com. And these are all my CEO interviews. And the very last one right here is Stem. And then SoFi last week that actually got a lot of views. So great interview with John, super nice guy. He's got a pretty significant or legit background working with General Electric. So this is a company I remain bullish on. They are in the smart energy storage space, renewable energy, mostly solar, a little bit of wind, primarily what they call C&I, which is commercial and industrial. So big warehouses, big Fortune 500 companies that have campuses, large buildings. They're putting their own solar panels on their roofs, or big solar farms, next to their campuses. This is like Google, Facebook, Amazon, Walmart, Home Depot. They're all big customers of Stem. Some of them, or most of them, already had the hardware in place, meaning the energy storage systems that are coming from companies like Tesla, Samsung, LG, General Electric. But STEM is essentially, in most cases, taking over as the software provider. So, they recently won over a big project in Southern California, huge project. I forget how many different sites it was, 10, 15, 20, I forget. But STEM came in there, and so the developer that owns that project did an RFP, request for proposal. And so I think it was like 8 or 9 companies, all submitted for that proposal, and STEM ended up winning it, which is a really, validation to how much better their software is. And that project developer has already seen a 30% increase in the efficiency of that, the storage systems. So that's why companies like STEM, this is early innings for this company. They've talked about, they're not really, so they're hardware and software only to the extent that they're reselling hardware. So if someone comes to them and needs a new system, they can work, they work with their partners like Tesla, LG, Samsung, install the hardware, and then their software sits on top of it. And they said they have 100% attach rate. So whenever new hardware is going in, then their software is coming in with it. But then there's also projects where that hardware is already in place, and they're just looking to find a better software provider, and that's when STEM can take over. John talks about the margins on hardware are 10 to 30%, but then the margins on software are 80%. And he's talking about 10 to 20-year contracts for the software. So, they're taking over one of these huge renewable projects, and that's revenue that's going to be coming in for the next 10 or 20 years at a minimum. And, they really started doing a lot of projects in California, but now that they have $500 million in cash on the balance sheet from coming public via SPAC, now they can go out and be more aggressive on the sales and marketing side. And that's what's allowed them to, get some recent wins in Massachusetts. And they've also announced that they're doing some stuff in Brooklyn, New York now. Obviously, those are 2 big states that have an emphasis on renewable energy right now. So I'm excited. I think this company has a very, very bright future. John talks about the TAM growing 25x over the next decade. And then I also think there's a lot of international opportunities. I know that STEM is already looking at projects in Europe and Asia and South America, working with a lot of distribution partners and resellers, so which they train up through STEM University. So I'm excited. Obviously it's a top 5 position for me. Although I will say, once you get past Upstart and Celsius, which together are probably a third of my portfolio, DermTech, ClearPoint, STEM, SoFi, Desktop Metal, Shockwave are all very, very close in position size. They really one day, DermTech might be third, and then the next day it could be SoFi because of price fluctuation. So don't try to build your portfolio to copy this directly. Just know that. So that's STEM. SoFi, I'll just look at the chart real quick for STEM. So we've seen a pullback here. I'm not even sure if this trend line is really legit or not. We're below the moving averages. I did my write-up. I did my write-up right in here, maybe mid-20s. So it's pulled back a little bit. We got some warrant stuff that's happening right now. I think maybe that's why we saw this sell-off. But having the warrant stuff behind us will clean up the balance sheet. Bring in some more cash. So if you look at valuation, so once again, I would not pay too much attention. We're already into the second half of this year, so I don't think looking at 2021 gross profit numbers is really going to help you out too much. I would pay more attention to these next year numbers. So STEM reported earnings a couple weeks ago, came in line with guidance at, I believe, 19 million. Yeah, 19.3 million, which was in line with estimates. Once again, I would not pay too much attention to, these year-over-year numbers. But, the important parts of this report were, so 474 million in cash, no debt. Confirmed, I know they confirmed guidance. I just want to see where it is on here. I don't see it, but okay. So I know they confirmed guidance for 2021 of 147 million and a backlog of 250. And this is a contracted backlog. So, these are revenues that are going to come through. But in when I did the interview with John, he talked about the pipeline. He says that they think 10 to 20% of the pipeline could come through as well. So, those are obviously, deals that are not under contract, but this 250 number are deals that are under contract. So, that's a pretty significant pipeline for, or backlog for a company this size. If you look at the estimates for STEM, obviously growth this year looks insane, 305% year over year. But, so whoops. But if they get to the 147 number this year, and then even the analysts are looking for, pretty significant growth next year of 114%. So when you look at next year's numbers, if you can do triple digit growth and you can buy a company trading at under 35 times gross profit, I just think that's a pretty decent risk and reward. So, that's why I remain very bullish on this company. Great growth, very reasonable valuation, ton of cash on the balance sheet, very, very hot sector. This infrastructure bill is probably going to be a nice tailwind for them as well. More companies moving to renewable energy. There's a whole ESG narrative with it as well. So I can't find a lot of reasons not to like the company. If you were going to pick apart one thing, it's the current gross margins, but that's because a big chunk of the revenues is the hardware up front, and then the software, which you obviously you collect that software on an annual basis over the next 10 or 20 years. So as the upfront gross margins look low because it's the hardware, and then over the next 5, 10, 15 years, we're going to see these gross margin numbers come up dramatically as the software revenues start to kick in. So I think the other thing you need to like about this stock is they're going to be EBITDA positive next year, which John confirmed in the interview. So this is a company that's growing at triple digits that is actually going to start making money as of next year, unlike other companies out there that are growing fast but losing a ton of money. And I could point to a lot of them as well. So a lot to like here. Definitely going to be a staple in my portfolio for a while, I hope. Okay, SoFi. So if you go back to the YouTube page, the second to last interview was with Tony, I would say Anthony Noto, who's the CEO of SoFi. This was my most recent write-up before STEM. So I guess my second most recent write-up on SoFi. A lot of things to like about this company. Starting with a very strong management team. So SoFi, there's probably a few ways to describe them. Like you could call them a neobank, which is basically a bank that doesn't have any branches. That's how I kind of like a digital first bank. You could call them a super app for finance. As you can see here, they have all these different services from lending to deposits, investing, credit checks, financial planning, investing, insurance, like basically everything. And that's sort of what they're trying to be. They're trying to be an all-stop, like an all-in-one or a one-stop shop, mostly for millennials. Like I think that's definitely who they're catering to, people in their 20s and 30s that maybe don't have a relationship with the bank or a financial advisor. And, they don't want to go into a branch, and they're looking to do everything, from their desktop, from their mobile app, or their phone. And SoFi can do that for them. it's kind of a nice flywheel here because SoFi is one of the largest student loan refi companies. So what they're doing is, I mean, you graduate college, you have all of this student loan debt at 8, 9, 10%. SoFi will refinance that for you for, half of the rate, 3, 4, 5%. And then now you're kind of in that SoFi ecosystem, and now they can start to sell you more products, more services to go along with it. And that's one reason they have such a sticky business, with a lot of cross-selling opportunities, as like any other company, as you add, multiple products, you increase the, not just the ARPU, which is the average revenue per user, but you also, increase the lifetime value of that customer. And then also the retention rates go way up, right? Because if you have like your loan and your investments and your insurance and your cash deposits at one company, like the likelihood of you switching all of that to another company is less likely the more products you have, because the bigger the pain in the ass it is, to be honest. So there's a lot to like here. And then on top of it, so you have like two big segments here. You have consumer, which is really lending and financial products, which we've just talked about. And then you have enterprise, which is their Galileo division, which is the company that they purchased last year for 1.2 billion, which is basically powering a lot of other neobanks and fintech companies. So if you go to Galileo Technologies, where is it? So if SoFi was just a consumer-facing fintech, I would not be as excited as I am. But because they own Galileo, which I think is like, this is going to be their golden goose. So if you remember 20 years ago, eBay bought PayPal for 1.2 billion, and now PayPal's worth like 300 billion, obviously spun out of eBay. Google bought YouTube for $1 billion. Facebook bought Instagram for $1 billion, and SoFi bought Galileo for 1.2 billion. I don't know if Galileo is going to turn out to be the success of YouTube or Instagram or PayPal, but I think Galileo has tremendous growth potential because they're basically like this foundational infrastructure layer for all of these other fintech companies. So literally, Robinhood runs on their platform. SoFi Money runs on this platform. TransferWise, which just changed their name to Wise, Dave, Revolut, Verizon actually launched the money service that runs on Galileo. Like, it's crazy. And even MoneyLion, which is actually a write-up I did a few months ago. So I mean, literally like the largest fintechs in the world. And that's what I like, the world, meaning like you get international exposure to emerging market fintech through Galileo. And Galileo is kind of like a toll booth. So when these companies are building their apps and services on top of Galileo, and they're issuing cards and digital banking solutions to their customers, every time those products get used, Galileo is collecting a fee. So this is like the ideal, toll booth concept. So I just think Galileo is a really exciting piece of this business. Kudos to Anthony Noto for acquiring these company. When you've seen some recent valuations like Plaid. So if anyone knows Plaid is like an API infrastructure that connects banking to like other apps. So if I want to like connect my TD Bank account to my Interactive Brokers trading account, like a lot of times it's Plaid that's acting as that connection gateway. And I think it was Visa that was going to buy Plaid for like 7 or 8 billion, and that deal got blown up by the regulators. And now I heard that Plaid is out trying to raise money at 15 billion. Robinhood just came public at like 30 or 40 billion. Revolut just raised money at 25 or 30 billion. Like, some of these fintech valuations are insane. If you look at Marqeta, Marqeta just came public recently, and they're already sporting a valuation of almost 12 billion. And so Marqeta is sort of like Galileo, but more for credit cards. But Galileo, so Anthony Noto on the Q2 earnings call did say that Galileo is developing more, or maybe it was my interview, either way, I can't remember which one, maybe both, did mention that Galileo is developing new products and services for their enterprise customers. And I have a feeling that we're going to get something similar to Marqeta. So we could see Galileo getting into Marqeta's space, maybe even in the future getting into Plaid's space as well. So that's sort of the optionality that you get with Galileo. And honestly, if Galileo was a private company still and had not been acquired, I guarantee they'd be out raising money right now at probably a $5 or $6 billion valuation. So I think in 5 years, Galileo could be worth 50 billion, and the rest of SoFi could be worth another 30, 40, 50 billion. So you could be talking, 5, 6, 7 years from now, SoFi might be a 80, 90, $100 billion company, which is where Square is. So, Square has done it. Square proved this. They're a $121 billion company. And if you look at their chart over the last 5 years, it's freaking ridiculous. I don't know if I can pull it up here. Oh, maybe I can. So, even if you go back, was this not even 2 years, a little less than 2 years, and this was 60. I think if you go, I've looked at these charts before. If I go to Yahoo Finance, I think Square is up 20x over the last 5 years. I just want to double check. 5 years. Whoops. Full screen. So 5 years. Oh my God. So stock was in the 11s. So 268 today. 268 divided by 11. So it's a 20 bagger. It's up about 24x over the last 5 years. So I don't think there's any way SoFi does 24x over the next 5 years, because if they did that, they'd have a market cap of like $300 billion. And I don't think SoFi is a $300 billion company in the next decade or two. But it just shows, how much opportunity and growth potential there is in fintech. So, okay. So real quick. So SoFi did sell off a little bit after earnings. And I think one of the reasons why, which I believe is it's overdone. So this is when they sold off after earnings. So earnings were a little light, but the reason is because of the student loan moratorium. So very, very detailed report if you want to go through it. So, year-over-year growth, member growth up 113%, total products up 123%, revenues up 100%. Really, really strong numbers right now. And adding more members and adding new products and cross-selling products is really what this story is all about right now. But so lending is where they're taking a hit. So Anthony said that they're going to take I think it was $40 to $50 million revenue hit in the second half of this year because of the student loan moratorium, which basically says that you don't have to repay your student loans right now. And that moratorium was supposed to end in September, and now it's been pushed off until January. So, but I just think that what that means is we're kicking it down the road. We're kicking those revenues into 2022. So once we get into 2022 and the moratorium ends, and now you have to start paying back your loans, I think we're going to see a mad rush into companies like SoFi, where people want to start refinancing their student loans again, because now they have to start making payments again, and they want to reduce those payments. So that 40 to 50 million of revenue, yeah, it's coming out of 2021. I just think we're picking it up and putting it into 2022. And the part of the story that I think is being missed here is they kept their guidance for 2021 at 980 million because even though they're losing 40 to 50 million on the student loan piece of the business, they're making it up in their other pieces of business, which are stronger than they expected coming into this year or coming out of the SPAC, whatever. So I just feel like that part of the story is being missed, that everything is cranking right now for SoFi, except for student loans. But once we get into 2022 and the moratorium's over, you have financial products cranking, you have Galileo cranking, and now you have lending cranking even harder because now there's all this pent up demand for student loan refi business. So I think the sell-off in SoFi has created a really, really good buying opportunity. I'm loaded up right now on the stock. My cost basis is 16, about 16. So I'm a little underwater right now. I don't care. I think this could be a $30 stock by the end of next year. So I think there's about 100% upside in this stock over the next 18 months or so. One other thing that I think could be a catalyst in the near term for SoFi is analysts picking up coverage. So, SPACs have been trading like crap. A lot of them have, because a lot of them have missed their earnings right out of the gate. They've they've pulled guidance, they've reduced guidance. So I think a lot of analysts have been very suspicious of SPACs and didn't want to pick up coverage on these companies until they saw at least one quarterly earnings report. And, Stem met expectations, hit their numbers, and kept guidance for the year where it is. So to me, that's a win. You had companies like App Harvest, Catapult, View, and like Open Mile, and like literally dozens of others that just came public in the last few months, de-SPACing and missed their numbers, lowered guidance, and those stocks have been an absolute freaking train wreck. And shame on management, shame on the SPAC sponsors, shame on the PIPE investors. Like shareholders, retail investors have really been screwed over by some of these companies, these SPACs. Whether or not they were intentionally lying to us to inflate their prices, which is probably true, or they were just way too optimistic or ambitious on this year, the business model, etc. We'll never know. But some of those SPACs have been absolute freaking train wrecks. I mean, like if you look at, so App Harvest is really the only one that I accept some blame for, because this was a write-up of mine a few months ago. Now, I think I did the write-up back, I don't even remember, maybe here, probably here, right before the spike. So I probably did the write-up in the low 20s, if I had to guess. Obviously, after my write-up, it took off, and it's been just shitstorm. I don't know what you want to call this. So, this was a story of, I think I underestimated the size. Like, there's a few things I did wrong. First, I trusted guidance from management. So I thought the numbers that they put into the presentation were doable for this year. I also thought they would have some pricing power on their produce. And it turns out that none of that was true, that the estimates were way, way too high. Guidance was a joke. They don't have any pricing power. They're running into all sorts of problems, bringing on new distributors and retailers. And then, from there, like, you have to wonder, how are they going to finance this growth of new facilities, these indoor vertical farms. So, this story has really, really fallen apart quickly. And I am mad at myself. I mean, I lost money on this too. I mean, I got stopped out somewhere in here on the big drop. I typically have stop losses on a lot of my companies. So I got stopped out here. I tried to get back in here. I got stopped out again. And then I kind of gave up on it. So, and, but this right here is when they reported their Q2 earnings, missed, pulled guidance, freaking disaster. This is when I lost all trust and respect for management. And I doubt I will ever own this company again, because I just don't think that we can trust management. And I think in theory, indoor vertical farms sounds really great. We ship over 50% of our produce from outside of the US, mostly Mexico. Like you think about all the wasted transportation costs, fuel, pollution, blah, blah, blah. And then on top of that, you have all of these forest fires, and you have the inefficiencies of outdoor farming and indoor vertical farming with, where you're collecting rainwater, recycling water, 30x yield, using special lighting and sunlight and all that other fancy stuff and robotics. Like it all sounds great. It just, I don't know if it's like, I don't know if it's doable. I don't know if the model actually works. I don't know if you can actually make money running these indoor vertical farms because of these, the infrastructure costs. Because I don't know. So maybe I was really wrong. I was bullish for the wrong reasons. And for anyone that lost money on App Harvest, I apologize. I did too. But I cannot get behind this story anymore until management, at least, and I don't think I'll ever own the stock again, but I think anyone that wants to own the stock and believes in this long term, because I do think this companies like this would be good for the environment. They would be good for our food supply, providing more fruits and vegetables at affordable costs. I guess that's the question though, is will they be affordable? Or do they have to sell these products at a premium in order to make the economics work? And that's what I just don't know yet. And I think that is to be determined. But you start to look at some of these other SPACs, which I have nothing to do with. And View has been absolutely slaughtered. Catapult, absolutely slaughtered. I mean, just freaking disgusting. Mile, absolutely slaughtered. Origin Materials, these are just ugly, ugly charts, brutal. So sorry, kind of got off on a tangent there, but so I think the whole point was, I think a lot of these SPACs have disappointed investors. They've pissed off investors. They've pissed off analysts. So I think analysts have been very reluctant to come out with, ratings and price targets too soon. So that could be one catalyst for SoFi on the horizon is, we might see, now that they've reported earnings, we might see more analysts coming out and picking up coverage on SoFi. And at these prices in the mid-teens, I would expect to see a lot of buy ratings and price targets north of 20, probably in that 20 to 25 range. Okay. So that's pretty much SoFi. Let me just, so there we go. So estimates this year, the company already confirmed 980. So, 966 is probably on the lower side. Next year, assuming lending comes back really strong, financial products continue growing, we see, they've already talked about on the investing side, they're going to probably add margin. They're going to probably add options. They're already doing crypto. They're going to add more crypto. Possibly international expansion, Canada, Europe, maybe through acquisition, maybe organic growth. And then the other big catalyst that we haven't talked about yet that I'll just, real briefly is the national bank charter. So they did buy a bank called Golden Pacific. So they actually filed for the bank charter before the acquisition. Then they made that acquisition, which should speed up the approval process. I asked Anthony about it. He didn't give a timeline on it, but I think there's a good chance we see that approval happen in the next 6 months or so. And, the benefit of that, it's all about cost of capital. So Anthony explains this on the interview, because they're not a bank, they can't lend out of deposits, right? Out of customer deposits, which is how banks do it. I go deposit $1,000 at my local bank, and then that bank is going to take that $1,000 and lend it out to other people and make interest on that loan. And that's essentially how they make their profits. But if SoFi is not a bank, they can't do that. So so what they're doing in order to do lending, they're actually borrowing money from other financial institutions, paying them an interest rate so they can lend that money out to their customers, charge their customers money, and make the spread. But once SoFi becomes a bank, they'll be able to take deposits and lend off of those deposits. So they're going to be lowering their cost of capital by probably 2 or 3%, which then they can either pass on to their customers in the form of savings or offer higher interest rates on deposits. So it is a significant catalyst for the stock moving forward whenever it happens. Now, whether or not the stock moves on it, I don't know. I think it would. Whether or not it's priced in, I have no way of knowing. But I do think at $14, $15, this stock is really undervalued, especially if they can do 1.5, 1.6 billion next year. So where's my? If I go back to that chart. So SoFi not in here? Oh, here it is. So I have them at 1.6 billion next year because I expect, once they do options and margin, I think that's going to add some significant revenue. Plus, I'm expecting additional product launches from Galileo. So that would represent about, if they do 980 this year, although if they're saying 980, there's probably a good chance they do a little bit more than that. So, 990, a billion. I think a billion would be pretty, a nice target number. But let's just say they do 980 this year, 1.6 billion next year. You're looking at, 63% growth next year at 21 times gross profit. Once again, not expensive, undervalued, very, very, you'll never see a bank growing at 63%. This is the benefit of being a fintech company that doesn't have all that legacy infrastructure costs and retail branches. So rather than, the insane amount of money it costs to operate all of these branches, they can take that money and reinvest it into sales and marketing to grow their member base, launch new products, R&D, M&A, etc. So, so another favorite stock of mine. Okay, Desktop Metal. Where should I start? So I did my write-up on Desktop Metal when it was a $14 stock. It has pulled back way more than I expected it to. Yes, it has kind of pissed me off, because this stock got up to 35 back in February, and I watched it pull all the way back to 14. Where did I do 14? I forget if I did 14. Yeah, 14 here, I think. So I waited for it to pull all the way back to 14. I thought maybe we were going to find a bottom in here somewhere, because this is where it spiked up here. So I thought this 14 level was kind of like a magic spot. And nope, we just kept on pulling back. Now, a couple reasons why, one of which SPACs are hated. Money's been flowing into the more profitable growth names this year. And then also, I think the third point was, I think some people were anticipating that their P50, which is going to be their mass production printer, would ship in Q3, but now it's actually been postponed to Q4. And I don't think we ever got like a definite answer that was going to ship in Q3. I think a lot of us were just hoping that it would, because the company always said second half of 2021, but on the Q2 earnings call, Rick confirmed that it's going to be 2021, Q4 in 2021. So I think that's why you've seen the stock start to move a little bit higher, because, end of August, they say beginning of Q4, that means early October. We're now 6 weeks out from that. I think you could start to see Desktop Metal continue to grind higher as we start to get closer to the shipping date of the P50. Now, there's always a risk that the P50 does not ship on time, or they have to delay it from the beginning of Q4 to the end of Q4, in which case you'd probably see the stock pull back again. But if the P50 does ship in the beginning of Q4, and if they either give us an update on shipment numbers, or we see, posts from customers and reviews and whatever, some exciting videos, like you could see the stock start to move higher, pretty quickly, because, those P50 printers cost over $2 million a piece. And any company that's going to be using them, I mean, might be ordering multiple printers, but they're also going to be consuming a lot of materials, which is also recurring revenue, or some of the materials are recurring revenue. Now, if you just want to look at just when I say production printers, so Desktop Metal has a bunch of different printers. They've been doing a lot of acquisitions. I think they've done 5 or 6 acquisitions in the last 9 months. Most recently, they bought a company called X1. This was a public company, so the ticker symbol was XONE. Bought the company for, I forget, it was like a $30 or $40 premium over the closing price. But as you can see from the chart, X1 sold off a lot this year too. It also peaked back in February, and at what is that, 60 something? Yeah. So X1 peaked back in February at 66, and they're paying mid-20s. So way down. So what is that? So they basically bought X1 at a 63% discount of what it was trading at back in February, but Desktop Metal's down that much too, so it really doesn't matter. But Desktop Metal has a bunch of different printers. So the studio and the shop are the 2 main ones right now, but then the production system is the P50, and this is the one that's coming out. So this is going to be the high-speed mass production printer. So to be honest, the entire industry, like 3D printing, has been this dream for the last 15 or 20 years that it would, what they call additive manufacturing, or it would completely change the manufacturing industry and allow companies to bring certain manufacturing in-house, whether it's prototypes or certain parts can be made like on their own premises rather than having to rely on, vendors or other companies to make stuff for them, ship it in, and there could be delays and freight costs and tariffs. And 3D printing was supposed to change all of that, except, to be honest, a lot of the 3D printers over the last 10, 15 years just haven't lived up to expectations. Too slow, too many problems. They can't print enough different materials. And, hopefully Desktop Metal is about to change all of that with the P50. So there's like 200 plus qualified materials, stainless steels, gold, silver, like all sorts of stuff you can print on this, even wood. And this, this printer is supposed to be 100 times faster than the legacy printers. And this is, they're using what's called single pass binder jetting technology. And this is supposed to be the true revolutionary game changer that the industry has been waiting for 15 years. So that's why I'm so excited about Desktop Metal. That's why it's a large position for me. I've been adding on the pullback from 14. So I think I started a 3 or 4% position around 14. It's pulled back. I've added to that position. It's probably around 5% right now, and my cost basis is under 10. So, I've added pretty significantly to it because I just believe in, what this company is going to be able to do over the next couple of years. So if you look at the estimates, so Rick did confirm on the Q2 call that revenues this year would be above 100 million. Hopefully on the Q3 call, we get a little bit more clarity on that because that's kind of a vague number. And I also don't know if that 100 million that he referenced includes the revenues from some of these recent acquisitions. For instance, if you look at X1's supposed to do 30 million this year, I believe. So when he says, 70 million. Okay. So when he says over 100 million for the year, like, is he including some of that, all of that, none of that? I don't know yet because I don't even know when that deal's supposed to close. So a lot of questions on revenues for this year. Obviously, when they reported Q2 earnings, and as you can see from the estimates on earnings, you're supposed to get a big ramp up at the end of this year. So, 11 million in Q1, 19 million in Q2, and then a massive jump in Q3 and Q4 when we obviously get into more printer shipments, especially the P50. So, being able to hit these numbers is going to depend on whether or not the P50 ships on time or not. What else? This is sort of a similar story to STEM in the case, gross margins are going to look low now. They will increase over time. Rick has said that gross margins on these machines should at some point be able to approach 50%. The industry as a whole. So if you look at Desktop Metal's investor presentation, it's not there. So Desktop Metal investor presentation. So they talk about the industry getting to 147 billion by the end of the decade. So by 2030, 146 billion. And Rick has said that he thinks that Desktop Metal can capture 10% of that market. And I do think that's why they're being so aggressive right now on acquisitions. They are trying to build a portfolio of the best printers with the most qualified materials and the most significant intellectual property portfolio to set them up for the next decade. Now, if you just do some math, and this industry actually grows to 146 billion, and Desktop Metal is able to capture 10% of that, that's 14.6 billion. And let's say gross margins really are 50%. I mean, you're talking $7 billion of gross profit by the end of the decade. And I mean, you could easily see, 30 times, 20 times gross profit. You're talking a $200 billion company. So, I have no idea if they get there. That sounds a little bit too ambitious, but that's the potential of a company like this if these printers like the P50 really turn into what we think they can and revolutionize the industry. Because the automakers, the aerospace, the plane manufacturers, I mean, manufacturing is a multi-trillion-dollar industry. And like, if you think about a car, I mean, these parts are made all over the world and shipped in. And there are delays. I mean, how many times do ships, get stuck in port or can't even dock in port to get offloaded, to have to put those containers onto trucks drive to Detroit. I mean, there's just so many problems with that supply chain. And 2021 or 2020 was a good example of what happens when you get supply chain disruptions. You've seen a lot of companies like Ford and General Motors have to cut back on manufacturing because there's a chip shortage. So, I mean, not that Desktop Metal is manufacturing chips, but they're manufacturing a lot of other parts. And I just think that at some point, if these machines prove themselves, these companies are going to want to take some of that manufacturing in-house, where they have more control over design and speed and cost and a lot of other stuff. So, and there's no waste. Like the, additive manufacturing is competing against these old styles of manufacturing, like molding or stamping, and there's a couple others I can't really think of right now, but there's a lot of waste in that process. And Desktop Metal, because it's powder, and if you've ever seen these machines go, basically like whatever doesn't like get printed, like that powder like falls through, and then it basically gets recycled and reused. So it's a very like eco-friendly, green way of manufacturing. And then the coolest thing is Forest. So Forest, desktop. Yeah, it's probably on their website somewhere. But anyways, Forest is wood 3D printing, which is really cool. And this is basically using resin and sawdust to create wood products. And you can actually use the P50 printer for wood as well. So the P50 can do metals and stainless steels and all sorts of alloys, and then even wood on top of it. So that's, I mean, I don't even like, this is a 30, 40, $50 billion market. If you think about like the intricate designs that you can do with 3D printing that you can't do with any other forms of manufacturing, and this goes for wood, fiber, this goes for a lot of different materials. There's just stuff that you can do with 3D printing that you can't do in any other forms of manufacturing, because you can get so much more intricate and detailed with 3D printing, because you're basically printing thousands and thousands of layers on top of each other, which is just a completely insane way of doing it. But when you see it in person, it's mind-blowing. Okay, so that's Desktop Metal. Once again, I hate to keep saying this, but this is a 2022 story and a 2023 story, because that's when we're going to see the true revenue growth from the P50 shipping. So I think right now, once again, under $10 is a tremendous buying opportunity for Desktop Metal. If they hit the numbers this year, I have 110 million. I think, if you start to include some of the acquisitions, I mean, they could easily do 120, 130, 140 million this year, depending on how many P50s they get out the door. But let's just say, 110 million this year. Obviously, big growth over next year. I don't care about that. 30 times gross profit, whatever. You start to look at next year's numbers, and if they can do, so the estimates for next year from the analyst are about 100% growth over this year, maybe a little bit more than that when you throw in these acquisitions. So if they can do 110 this year, they should be able to do at least 230 next year. I also think there's a chance we see 120 this year and even 240 or 250 next year. So, you get into the 250 range. Now you're looking at 14 times next year's gross profit for, once again, a company growing triple digits. So that's a no-brainer to me, assuming that this company lives up to the hype with the P50. So okay, so Shockwave, this is not a company that I've done a write-up on, but it is a company that I'll just spend a few minutes talking about. So this is a med tech company. So the name Shockwave is kind of cool because it explains what the company actually does. So they're basically, it's cardiologists, I believe, are primarily the people that are using it. And they are putting these like balloons into your vessels and like using shock waves created by this machine to break up any calcium deposits, which might be clogging up those vessels, arteries, etc. So really, like, there's a video, so you see, like, in the videos, you can see the cardiologist or the medical professional, like, literally pull this trigger, and then you see like a burst of air. I'm not even sure what it is, vibration. Really freaking cool. And then you see the faces of the doctors, and they're just all in shock. So this is a company, once again, that's putting up really, really impressive growth numbers. Now, the numbers this year are ridiculous because, once again, business was depleted last year. So they actually reported revenue growth in Q2 of like 450% year over year. That's obviously not sustainable for full year guidance. And then they raised guidance this year. So when they reported Q1 earnings, they raised guidance, I think, to 190 to 200. And then when they reported Q2 earnings, they raised that to like 220 to 230. So they, once again, they continue to see their business accelerating. They continue to beat and raise. Now, this is not a cheap stock necessarily on a multiple basis, but they're expected to be EBITDA positive next year, which is obviously a big step, right? I mean, we're going from a company that was losing $50 million a year a couple of years ago. Now they're making $50 million a year. They have tremendous gross, where's the gross margin? Oh, there it's 83%. So tremendous margins. And this is another company that should benefit once the pandemic's over, once they get these machines into more medical professionals' hands. So this is obviously, as you can see, a top 10 holding for me. I've been in this stock so I was in this stock earlier in the year, then I sold out of it because it looked really expensive. And then I jumped back into it when the stock right here. So at 160, little under 160, the stock bounced off of this trend line, going back to November. So this is where I took a position, and then I continued to add to it. And then we've kind of seen this trend line hold up several times here. So I keep adding to it on each of these dips. And, now it's a pretty significant position for me, breaking out to new all-time highs. And I used to think this stock was expensive, but they've really, as they've raised guidance for this year, and then you start to look at next year's estimates, it's not expensive. So look at Shockwave. Here we go. So look, like growing at over 60% with margins in the gross margins in the 80s, trading at 22 times gross profit next year. Not expensive at all. So this is a stock, if you don't own it already, I would keep an eye on it. If you get any sort of a pullback, I would absolutely take a position. And if you have any questions, I'm not a doctor. I'm not going to pretend like I understand this company, like every aspect of it. But, I've done, I don't know, 8, 10, 12 hours of due diligence. I've talked to some medical professionals that are familiar with the technology and have actually used the machines themselves. And we're obviously very impressed with it, and they have positions. But, just looking at the fundamentals, the recent performance, the financials that they're reporting, the guidance they're providing, next year's estimates, et cetera, add it all up. And, if you want to be in a high growth, high margin med tech business, this is definitely one that's worth taking a look at. So I might do a write-up on it. I'm not sure. It's had such a monster run this year. I almost feel like I'd be chasing it a little bit, and I'm not looking to bury anybody on a pullback. But, we came into the year with the stock at, where are we? Around 100, so we're up 100% year to date. We're up over 200% now. So it's had a big run, but I think it's justified, growing at 230% this year, probably 65, 70% next year. I think this is a stock next year that we probably could see in the 250 to 300 range. Zim. Okay, so this is a stock that I really, really want to talk about. It's not a stock that most people are familiar with, and a couple reasons why. One, it's a shipping company, which is kind of boring on the surface, but once you start to dig in, you can see there's tremendous value with this company. So Zim came public earlier this year. I missed the IPO. I've been in the stock for probably since April, maybe the mid-30s, I think is when I got in. But over the last 3 or 4 months, I've done more reading on the company, the industry. I found a couple analysts that I really like, and they know this company very well. It's their favorite stock in the industry for a couple of reasons. So company came public like way down in the teens, like just insane how well the stock has done year to date. But so Zim is a shipping company based in Israel. They've been compared to they're the WeWork of shipping. And I know WeWork gets a bad reputation for, well-deserved in many cases. But the reason I say that is because WeWork doesn't really own their own spaces. They are renting office space from a large company and then re-renting it to smaller businesses. And that's sort of what Zim is doing. Zim is signing long-term leases with the ship owners and then leasing those ships out on a needed basis to companies. So there's a phenomenal spread there. And as we've seen shipping rates increase by 5x, 7x, 10x in some cases, depending on the market, and depending whether you're talking liquids or dry bulk, and then you're talking Asia or South America or Europe, rates have just skyrocketed, and no one knows when they're going to come down. They will probably come down in the next 12 months, but I doubt they're going to pull back all the way to pre-pandemic highs or pre-pandemic prices. So and I know this for a fact because I own companies that have to ship products overseas, but you used to be able to ship, get a full container, 40-foot container for $4,000 to $6,000. Now those prices are like $25,000 to $30,000. They have just exploded. So what's happening is Zim is making that money, making that extra margin. So you have a company here with an enterprise value of a little over $6 billion, because they have about $400 to $500 million in debt, but it's not really debt. It's more like leases. But they are going to generate a ridiculous, so look at these. So they're projecting over $9 billion of revenue this year, over $5 billion of EBITDA, and free cash flow over $4 billion, right? I just showed you that the entire enterprise value of the company is just over $6 billion, and they're going to generate free cash flow this year of over $4 billion, and next year of probably $2 billion or more. And if shipping prices stay anywhere close to where they are right now, this too is going to come way up. So there's a good chance that this company is going to generate enough free cash flow over the next 2 years to buy back every freaking outstanding share. Now, obviously, they're not going to do that, but they're going to do something. So there is an analyst. Yeah, here it is. So this is the maritime. He calls himself like a maritime analyst. This is the guy who I really trust, who loves Zim, who says there's still 50% upside. And this was just written a couple of days ago. So he talks about in here, and this is very, very thorough. So if you're interested in Zim, I would highly recommend reading this article. But he talks about, how the company is going to deploy some of this capital. So he thinks the company could distribute perhaps 50% of this free cash flow next year in the form of dividends, and maybe even more than that. And then on top of that, there could also be some stock buyback after this upcoming lockup expiration. So, you could see this company take $2 billion and pay that out in the form of a special dividend. And with, 115 million shares, take 2 billion divided by 115, you're talking at least $17 a share. And my guess is they would probably buy back some stock before they announce that, retire some of these shares. So let's say they bought back, 25%. So 115 million times 0.75. So let's say, you got 86 million shares left. Now divide that by 86, and now you get, 23, almost $24 a share. The stock right now is trading at like 48. So I think there is a chance that you could see a 50% special dividend announced sometime next year. Now, whether or not they do it all at once or they split it up into, quarterly payments, I'm not really sure. Maybe they reduce it and then, they decide to pay these dividends out over the next 2, 3, 4 years. Maybe they buy back more stock and do a smaller dividend. I'm not really 100% sure. But I think it's not just a shipping story. It's really a capital distribution story. So with that much free cash flow coming in this year and next year, I just don't think there's really any downside. So, I've been increasing my position over the last couple of weeks, expecting that this stock will probably, as more people start to realize what's going on here, and that shipping prices are probably going to stay high long enough for companies like this just to continue to print cash. I think you'll see this stock, gradually rise from, what's the high 40s right now into the 50s, 60s, and maybe even 70s or 80s by the end of this year, because people want to get into the stock before the company announces buybacks or dividend increases. So interesting company, a little bit different than the types of companies that I usually talk about, but I like trying to find these under the radar companies that have something unique going on that people are not paying attention to. That's why I got into DermTech. That's why I got into ClearPoint. That's why I got into Celsius and Upstart, companies that are not being given enough credit for, what they have going on, or, future revenues are going to accelerate and it's not being reflected in the estimates. So, that's where I think we can find some opportunities. CrowdStrike, that's been a position now for the last few weeks, by far and away the best cybersecurity company. I also added SentinelOne, which is, like maybe the second or third best cybersecurity company. Recent IPO, very expensive on a multiple basis. I would not be adding to it here. However, if Sentinel pulls back into lockup expiration this fall, you might get a nice opportunity to add some. Danimer Scientific, I almost did a write-up on this, but because it's a former SPAC, I decided not to. It's had a nice bounce off of these recent lows of 14. I did trim a little bit today in the 19 area. Is it really 20 right now? Wow, I can't believe this thing already got back to 20. Holy smokes. I mean, this thing's moved, wow, 50% in 9 trading days. Holy smokes. I mean, I knew it was oversold, but I didn't expect a 50% move that fast. So now I wish I had done the write-up right here, but I was just afraid that, former SPAC, unprofitable this year, should be profitable next year, recently did an acquisition, probably overpaid a little bit too much for the company they acquired. However, that acquisition will probably pay off over time because it will increase their manufacturing capacity. It'll bring down their cost of manufacturing. So I'm still digging into, I mean, I understand Danimer before the acquisition. I don't really understand as much the company they acquired, but Danimer is essentially so their main product is called Nodax. So what they're doing is they're developing these biodegradable plastics. So anyone that knows, that's been paying attention to anything over the last couple of years, knows that our planet has a plastic problem, crisis. Pollution. Our oceans are full of plastic. Our riverways, our landfills. There's freaking plastic everywhere because plastic takes 300 to 400 years to degrade. And these biodegradable plastics can degrade in, a couple years, if not faster than that. So, this is the opportunity. They're already working with some pretty large customers like Pepsi, Mars Candy. So I would encourage everyone. I mean, and right now they're investing a significant amount of money into building out more manufacturing capacity so that they can meet demand. And they say that demand is very strong. David Einhorn, who runs Greenlight Capital, he's a big shareholder. So, like I said, so they're expected to do about 70 million this year, double that next year, be profitable next year on an EBITDA basis, and even net income, which is not something you normally see from a company like this growing this fast. Gross margins are not great, but they will continue to increase over time, especially with this recent acquisition. If you look at my spreadsheet here and you go to Danimer, it's starting to look really cheap on so Danimer, once again, so let's see. Okay, so let's just say they do 75. I think 70 this year is probably more reasonable. What do they have next year? 152. Okay, so 152. So, if they end up growing triple digits next year and becoming profitable, 24 times gross profit is a joke. I mean, this company should be trading at 40, 50 times probably gross profit, if not more, given, I mean, the market for this is almost unlimited. If you think about how much plastic is being processed right now and how much of that could transition over to a product like Nodax. So, once again, it's never going to be my largest position because I do think there is some significant risk here, but I'm still very, very bullish on this company for the next few years. And I think the valuation, even at $20 a share, and let me see right now. So 1.4 billion is the enterprise value. I think I have to update that. Yeah, because it's moved. It's I did this spreadsheet a week ago. Okay, so now it's at 36 times next year's gross profit. So a little bit more expensive now than it was a week ago, but I still think that's reasonable if they can hit 150 million in revenues next year. And I forgot to mention Desktop Metal. So Desktop Metal, or maybe I did. Yeah, I did. I mean, Desktop Metal does look like one of the cheapest stocks right now, based on next year's estimates and gross profit numbers. Okay. MP, so MP Materials, this is a rare earth mining company that owns a large mine in, oh shit, I always forget the state. It's not Minnesota, no. I know it's called the MP Pass. Why am I forgetting this? So the company is based in Vegas, but I don't think it's in Vegas. Oh, Mountain. Yeah, Mountain. Why did I say MP Pass? Mountain Pass. Where is it? I know it's out west. Where is Mountain Pass? Nope. I think it's California. Oh, it is. Okay, it is Nevada. Is it really? Huh. Okay. I didn't think it was in Nevada. I knew the company was based there, but I didn't think the mine was there. Oh wait. So I mean, for anyone not familiar, so there's different rare earths, but rare earths are used, and you can see some of the different rare earths listed here. They're used in batteries, and so that's where you get into like electric vehicles and robotics and drones. So all of these different industries need rare earths. This particular mine, I believe, is the largest mine in North America for rare earths, and I believe it's the largest mine outside of Asia and Australia. I have heard recently that there's apparently large rare earth mines in Afghanistan, which is why it looks like China is trying to buddy up with the Taliban, because China wants access to those rare earths, and probably Russia as well. But right now, I believe the two largest processors of rare earth materials or rare earth elements are China and Australia. And obviously, you have to ship those in large container ships, whereas U.S. companies that need rare earths would make a hell of a lot more sense to get those rare earths from locally in the U.S. domestically. So, and I just think that if China really does buddy up with the Taliban for access to those rare earths, that's going to create some significant tensions between U.S. and China, and who knows where that leads, and whether or not China will even cut off the U.S. from access to these sorts of elements. So that would also be a nice catalyst tailwind for MP. So I'm not an expert on this company, as you can tell, but I think Tesla's market cap is too big for me. There's a lot of other electric vehicle companies and battery companies and recharging companies, charging station companies, and I just don't want to play any of them. I just think MP is sort of the lower risk play on this industry, and they're profitable. I mean, they have strong fundamentals. They reported really nice Q2 earnings. Growth is nice. They talk a lot about pricing power. So as you can see, nice growth, insane margins. I don't think they show gross margin, but they talk about EBITDA margins. So, this is a very, very profitable business right now. Obviously it depends a lot upon, how much they can actually get out of the ground, the speed of which they can process those rare earths, and then, what the market is willing to pay for them. So, there are some other dynamics there, but, if you're bullish on, EVs, drones, robotics, and some of those other sectors, this is one way to play it. HiMax is, I've sort of been in this one the same time as Zim, semiconductor company in Taiwan. It is not as exciting as like a AMD or NVIDIA, but on a valuation basis, it looks really, really attractive. The company is going to do about 1.4 billion in revenues this year. Very profitable, nice free cash flow. And the stock is, the market enterprise value is like 1.5, or no, it's actually up to 2 now. So, but 2 billion enterprise value, 150 million in free cash flow. It just looks really, really cheap on the fundamentals. So now there is a possibility that growth slows down next year. I know the company has talked about increasing their manufacturing capacity, because there is a lot of demand right now for chips and they want to be able to keep up with it. So I think there's a chance that these estimates for next year are too low. But in the meantime, I just think the stock is really undervalued at in the 12. So every time it gets down to like the 12 area, I add more, and then I trim if it gets up to 15, eventually hoping for a breakout above 15 at some point. So this has kind of been the trading range that we've been stuck in for the last, 6 months or so. But I've added it. I added it right around here, I think. I think maybe somewhere in like this area, 12. Bought it down here and then added on the way up and so forth. If you look at HiMax on this spreadsheet, it's going to probably be one of the cheap. Well, I mean, it probably looks really cheap this year. Yeah, so trading at 3 times gross profit this year. 3 times gross profit next year. So pretty cheap. Compare that to NVIDIA, and NVIDIA, obviously a great company, but NVIDIA is trading at 26 times next year's gross profit with, ironically, the almost exact same growth rate. So, maybe the entire semiconductor industry as a whole is going to see, low growth next year, but I still think that's unlikely. I think most of these estimates for next year are going to come up, which makes these stocks look even cheaper than they do right now. AppLovin, Zoom Info, DigitalOcean. So these are kind of like, so there are some new stocks in my portfolio where half of my portfolio is these high growth, unprofitable companies, but soon to be profitable. And that's where I would put, DermTech, ClearPoint, Stem, Desktop Metal, Shockwave even. And then you have the other half of my portfolio, which is high growth and profitable. Some are not as high growth, some are not triple digits high growth. Some are in like that 30, 40, 50% high growth range, but great gross margins, great operating margins, already profitable, already generating free cash flow. And that's where I would put some of these stocks, App, DigitalOcean, Zoom Info. If you just want to look at the, like Zoom Info, for instance, which reported really strong Q2 numbers, gapped up and then pulled back, 48% growth this year, 30% growth next year. Gross margins are ridiculous. Operating margins are obviously very strong. And this is just a stock that, you can kind of put it in your portfolio and forget about it. With fundamentals that strong, I just don't think you have to worry about big pullbacks, on a valuation basis, very, very reasonable. Zoom Info is trading at 17 times next year's gross profit. There are plenty of software companies with 30% growth that are trading at multiples way higher than that. I mean, look at Cloudflare, for instance. I know it's not the exact same business, obviously, but still, this is one. Oh wait, never mind. The ticker symbol is net. So look, next year looking for 33% growth, so a little bit faster than Zoom Info, but trading at 56 times gross profit, so almost twice the multiple, with about the same amount of growth. Now, obviously, these numbers could be too low. Same with Zoom Info, but you get the point. Where I think Zoom Info is probably a little bit undervalued right now, and I would say net is probably a little bit overvalued. DigitalOcean is kind of, that same sort of company, great growth, great margins, already profitable. So steady 30% grower, gross margins in the mid 50s, EBITDA margins in the 30s. Once again, this is one of those stocks I think you can just put in your portfolio and forget about it. Hopefully getting close to breaking out to all-time highs. I think this is going to be a stock that hedge fund managers are going to fall in love with. And there's a lot of option once you dig into the business, and this might be a write-up that I do because I think it's a pretty interesting company. There's a lot of, I actually use DigitalOcean for a couple of the businesses that I own, mostly in hosting, but they do a really nice job, and they're very small business friendly. Like SMBs are kind of their focus. I don't think they're really going after the big enterprise companies. They're really focused on SMBs and developers. PavMed is not one I'm going to really talk about because it's very speculative. But if you like DermTech, then you might like this one. Slightly smaller market cap, a little bit less in revenues, but the same premise. There's a couple different businesses here, but I think the hidden value is going to be in their esophageal cancer testing. So basically like non-invasive pre-cancer testing for esophageal cancer. I think that's how you pronounce it. TransMedics, which everyone's probably familiar with. We're still waiting for FDA approval for OCS Heart, for DBD, which stands for donation after brain death. And then next year we should get FDA approval for OCS Heart for DCD, which is donation after circulatory death, which is actually a bigger opportunity and therefore should be a bigger catalyst for the stock price. We just had, about a month ago, we had the FDA hearing for OCS liver, which went really, really well. Phenomenal positive votes and comments from the panel. So I would expect no problem getting FDA approval for OCS liver. I think we're going to get FDA approval for OCS Heart, DBD. I think the big question right now that people are waiting on is what will the restrictions be? Meaning, if the FDA gives full approval and says that you can use the TransMedics OCS units under any circumstance for any distance, etc., then I think the stock could easily rally into the mid to high, like up here, like this range right in here. If we get full approval with really no restrictions, if we get approval but the FDA says we're not 100% sold on OCS versus ice cooler or cold storage, so because of that, we think OCS has value in longer distance transports of organs, but not shorter distance necessarily. So we think that if the transport time is under 2 hours, then a cooler is still the better way to go. But if it's over 2 hours, then you can use OCS. So that's kind of like, it's good, but not great, because it's still an opportunity, but not the whole opportunity. Maybe we get a little bit of a sell-off, or maybe that's priced in right now. So that's what I don't know. The stock has had a nice bounce off the bottom here. So we're up 25% in, a little more than a week. Whether we come back and test these lows or start to break out above, this 35 area, I have no idea. As you can see, like, it's a stock that I like, but I don't love, just because there's still all these risks in the business model. But if the stock pulled back into the mid 20s, I'd probably start adding again. 26, 27 is probably where I'd start adding again. Zillow Group. So this is a new holding for me. I think everyone knows Zillow, and the stock has pulled back 50% from the highs. So back in February, it got up over 200. It's pulled back, over 50%. I got into the stock right around here the other day, 94, 95. I just think it's way oversold. it's probably the best real estate technology company out there. They have a massive traffic on their website and their mobile app, which obviously acts as a feeder into other services like mortgages, home insurance, rentals, leads for realtors, etc. And then now they're getting into iBuying to compete with Open Door, and very significant, big balance sheet, great management team. I just think the stock looks very attractive at these levels, so I was willing to start a position. Not much more to say there. So Love, this is a new holding. I mean, this is like totally outside of my norm, not technology at all. This is essentially like a DTC couch company. But strong fundamentals, strong growth. It's definitely a small cap, under $1 billion. Growth last year was actually thought growth last year was a little bit better than that. But this is going to be the kind of company that grows at 30%, decent margins. It's probably not a long-term hold for me. It's probably more of a trade than anything else. I might only be in this stock for a month or two. I just felt like it was oversold here and due for a bounce, so I grabbed it right in here, and we'll see. I won't let it turn into a loser, so I'll have a stop loss set up probably around 51, or so my cost basis is 57, right? Yeah, 57. So maybe I bought it here and wrote it up, wrote it down. That makes more sense. So I'm not even sure. It's either way, it's a new holding for me. It's not a long-term position. I didn't want to be all technology, all med tech, all fintech. I felt like I needed a little bit of diversity in the portfolio. This is obviously a consumer discretionary company, but if you go to their website, they have really cool stuff, like these massive couches. I don't even think most people have a room big enough for these couches, but it's all about like being modular, so you can create all these different configurations with the couches. And then they have the sacks, which I know people that own these and they just say that they're freaking amazing. Like they just want to spend all day in the sack. So they're not inexpensive. Like they are on the more expensive side. Like these sacks can cost $1,000, but that's essentially what a nice couch or love seat costs anyways. So ZipRecruiter, the thesis here is pretty simple. Fundamentals are strong. Stock has pulled back. This is a recent IPO. This year was a big growth year. I think next year's numbers are way too low, because as this rent and mortgage moratorium comes to an end, which was announced today or yesterday, and there's like literally over 10 million open jobs out there that have to get filled in the next 6 months or so. I think ZipRecruiter is going to be one of those platforms that benefits from this, this surge in job searches and jobs needing to get filled. Great, where's the gross? Yeah, great gross margins, already profitable. This is not the kind of stock that is going to, triple in the next year. That's not why I really own it. What am I looking at? Oh, the charts. So there's really not much to look at here because it's a recent IPO, but if you draw a line here, something like that. This is probably a trend line that you can work with here. So I think if we broke down below this trend line, I probably wouldn't freak out yet. If we drop below this, I'd probably sell it. But I think if we stay above this trend line, I think this is a position that you can start to add to. Where are we? Yeah, down 25% from the highs. So, which is kind of like the same as Roku. So Roku is another stock that I added recently off of this bounce. So, You know, if you go back on Roku all the way to last March, wow, there you go. So you had this very, very defined trend line all the way back to last March. You know, where we bounced off it in May, came back, and I added to Roku right on this bounce. And now I want to see if we can hold above it. Now, this is not a stock that I'm in love with. This is not a stock that I need to hold long term. So if we can't hold this trend line again, I'm out. So I don't have a stop loss set up yet, but I probably would somewhere, you know, depending somewhere in this area. So, you know, let's call it 346, maybe in that area. So my cost basis is 350. So yeah, I mean, where is it right now? 358. So I'm a little bit above water. So I mean, I'd probably let it turn into a loser, but a small loser. So, you know, whatever, yeah, somewhere in here. So I mean, I'm willing to ride it. You know, it's down 25 or 30% from the highs. And if, like I said, if we break this trend line, if we can't hold, I'm out with a, you know, 2 or 3% loss. So I actually tried doing that today in Moderna. I took a position in Moderna. This is a stock I've been eyeing for a while, trading at about 13 times earnings. I mean, obviously one of the big beneficiaries of the pandemic with their vaccine, pulled back about 25%, 20 or 25%. Well, I got to 500. So I think it pulled back 20% from the highs. And I thought maybe, you know, this like little trend line here would hold up today. So I took a position pre-market, right around 400, added to it on the way down with a stop loss at 382, which got triggered. So I was out. So I will now wait and see if we can form some sort of a base here on Moderna, you know, maybe wait for some of these moving averages to catch up and, you know, look to get back into the stock somewhere around here and hopefully ride it for the next push higher. So, you know, I try to manage my portfolio in this way where even if I like a stock for the next 6 to 12 months, I am still willing to set up stop losses and dump it if needed, if things just don't really work out for me in the short term. You know, Coupang is another one that I got into in the last week. So this is Amazon of South Korea. We are right now. So I don't have a stop loss set up on it right now, but I did say in my StockTwits room that if we broke, I think 30, I'd probably get out. Because if you kind of blow this up here, oops. I mean, you can see that we are like really, really testing this prior low just a few days ago. So you can see that the low here was 30.18. Right here, it was 30.65. So, you know, I really, yeah. So, I mean, we're right there, you know, I mean, my cost basis is 31.61. So, I mean, I'm willing to take a small loss, but I might add to it right here and see if we can get a bounce in the next few days. But, you know, it felt like at the current, you know, down 50 or 55% from the highs. If you look at next year's numbers, you know, $51 billion enterprise value. Gross margins are not great. They're still losing a little bit of money, but, you know, they're almost profitable. And once they turn profitable, they should have some pretty significant operational leverage in the business model. Gross margins will probably tick up in the coming years. But if you look at my chart here, Coupang, you know, trading at less than 10 times next year's gross profit. So, I mean, that's just really, really cheap, which makes me not want to, you know, get too worried right now about using a stop loss because it's already so freaking cheap. Now, I mean, could it pull back to 28, 26? Yes, but I just don't think we go much lower here just on valuation. And I think pretty soon you're going to see some big buyers come in and start to build positions in this stock. Just, basically on valuation alone. And then also the kind of the second part of my investment thesis here is for investors, large fund managers that want exposure to Asia, but they don't want to be in China because China is just such a big risk right now. This is one way to get exposure to China, not China, to Asia outside of China. Obviously, you have Sea Limited. There are a few other companies over there, but you also have Coupang as well. Now, obviously, South Korea is not, as large as China. China is like 1.5 billion people. South Korea is like 55 or 60 million people. So much, much smaller, but I still think there's some decent growth potential. And when you dig into Coupang's business model, I would say it's like core Amazon, e-commerce, delivery, logistics, warehousing, and then they also have a big food delivery business, restaurant delivery business. So it's kind of like Amazon core business plus DoorDash plus Instacart, maybe. That's probably the best way to describe them. And they have this sort of like Prime, you can pay a monthly fee to be a member, and that, saves you money, gets you faster delivery, faster returns, etc. So just a name to keep an eye on. Because I mentioned China, I'll talk about Futu real quick. So this has been a really disappointing stock. I wrote about Futu back in December when the stock was at 40. So right around here is when I wrote about Futu. Rallied to 200 very quickly, came back down, hit 100, came here, hit 100, up, down, hit 100. So, on two different occasions, it looked like 100 was going to be support. And then here we broke it. And now we're kind of like, sitting around in this 100 area. I no longer own Futu. I did sell it a few weeks ago in the 90s. I just got sick of stressing out about China and the CCP and which companies or industries they might go after next. It sucks because if you look at the fundamentals for Futu, this should be a $200 stock, but because of the CCP, it's trading at, under $100. It's probably trading at 20 times earnings for a company that's growing at well over 100%, just a massive discount to what the true value of this company should be. But the CCP has proven they do not care, that they are willing to sacrifice shareholders for their own mission, whatever the hell they're trying to achieve, dominate the world, control, power. They've already destroyed their education industry. Then they started to go after gaming and Tencent and Alibaba. And I just didn't feel like waiting around to see if they were going to go after Futu. So it sucks because, I was adding to Futu on the way up here, trimmed some, added some, trimmed some, added some. My cost basis was over 100. And when we got, this is a, pretty decent trend line right here. When we broke through here from this, so the stock was trading about here when we got the Didi news. So this was a $180 stock the day before we got the CCP going after Didi after their IPO. The stock dropped here. That probably should have been the signal for me to get out, take profits, ask questions later, wait for the dust to settle. I thought, okay, well, this news will subside in the next few days. Oversold here, we'll bounce back. Nope, it just kept on getting worse. It was just I don't know what you want to call this, just the night falling. And soon as we broke this trend line at 130, I should have been out. I should have been more disciplined. I should have listened to my risk management strategies, but I just kept saying, nope, this stock is too cheap. The fundamentals back, support a valuation in the 200 range. I'm not going to dump it until we get back there, convincing myself otherwise. It looked like we were starting to rally, and then boom, just more bad news. I think this was the 10-cent news that did it. And I finally just said, you know what, screw this. Like, I am sick of this. I love the company. I interviewed the CFO a couple months ago. Arthur Chen seems like a great guy. I think the company is doing everything right now. Huge growth potential. They're getting into new markets. They're expanding internationally. They've gone into Singapore. They've gone into the US. They have a completely separate app from Futu, which is called Moomoo. A lot of reasons to like this company and like the story long term. It's just you still have that unknown variable, which is the CCP, which has shown no mercy recently on any company, and they're willing to go after any industry. And I just worried that one morning I'm going to wake up and they're going to say, you know what, we don't want our citizens investing anymore in U.S. companies. And if that happened, you'd see Futu down 30-40% probably. And I'm not willing to take that risk. So even though I had a cost basis that was back above 100, I sold it at like 91 or 92. I did take a loss on it. It is what it is. You have to take your losses sometimes and move on. I am way less stressed out without owning any China stocks. I honestly don't think I will ever own a China stock again. I think this was my last battle with the CCP, and I lost. And I think a lot of other investors probably feel the same way. If you are a large endowment, hedge fund, pension plan, and you have all of these phenomenal companies in the US to invest in, and Europe, and even other parts of Asia or Asia Pacific or even South America, why even waste your time with China? I know those companies look cheap, but you also have a lot of what's the right word? I'm trying to I just don't know if you can trust the numbers. You have a lot of unaudited financials. You have this VIE structure. You don't have a lot of like SEC regulation or transparency. So at this point, I just think China is uninvestable, at least for me. So it's too bad. Like I liked having Futu. I liked having exposure to that massive opportunity, owning a fintech in China based in Hong Kong, but I'm out. One last company I will talk about is Aterian. So this one is by far and away my biggest loss of the year. I think for a lot of other people it is as well. At this point, I have nothing really nice or positive to say about Aterian. Is it a buy at these levels? Maybe. I mean, it looks like it's up 45% today, but I just don't think this is a company that you can trust right now. I don't think management is trustworthy. My entire investment thesis for this company was hinged around a few different things, all of which have blown up in my face. So first there was kind of three different segments to the business. There was one, they were using their Amy AI software to identify opportunities on Amazon where there were, let's say, categories where there was demand but not enough supply or not enough high quality sellers to meet that demand with low ratings and reviews. So Aterian would work with their Asian manufacturing partners to develop new products to meet that demand, ship those products over, sell them on Amazon, make money. The second was M&A. So they were looking to acquire existing e-commerce brands for 5 times earnings, 6 times earnings, profitable companies, strong free cash flow, strong presence on Amazon, strong ratings and reviews, and purchase those companies, get rid of management, get rid of a lot of the people, get rid of a lot of overlapping expenses, get rid of office rents and all that other crap, and essentially reduce their fixed expenses by 80%, thus bringing more cash or profits to the bottom line, which generates more free cash flow, which makes these deals very accretive. And then they can use those profits and that extra free cash flow to go out and do more M&A or pay down debt. And then the third segment was Amy, if they were able to prove the value of Amy to other e-commerce companies, then they could sell Amy and generate software revenues, very high margin software revenues. And maybe that would increase the multiple of Aterian in general. Now, Aterian got up to, so I did my very first write-up on Aterian back in December at $12. The stock rallied 4x from December until February. It was not worth $48. This is when the company should have been doing more M&A, more stock offerings, getting a larger, cheaper credit facility in place. Unfortunately, they did none of that. In fact, I think management was selling their own shares at the time, which should have been a red flag. Instead, and then we got a short report right in here. And that short report was kind of the beginning of the end. Maybe I should have paid more attention to some of the stuff that was being said in there. I still think a lot of it was fluff. Looking back, there were some red flags, though, that I should have digged a little deeper into. But we got Q1 earnings, which looked all right. They gave pretty bullish guidance for the year. They announced the acquisition of Squatty Potty, which I think they overpaid for. If you add up all of the stuff, inventory, price paid, blah, 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 earnouts, it came up to like $29 million, which I think was like 5 times earnings, maybe. I just think it was a little expensive. I think Squatty Potty I don't think it's a premium brand. I think it's a declining brand that was hot 5 or 6 years ago from Shark Tank, and I don't think anyone really cares about it anymore. And it's a pooping stool. So I just thought it was a bad acquisition. I should have convinced myself of that and sold the stock. But what kept me in the stock was the guidance the company gave. And they gave 2021 revenue guidance of $360 to $390 million, which made me think that, that even though there were concerns of supply chain problems, that the company was going to be able to navigate those problems. And clearly, when we got Q2 earnings, all of that was not true. They proved that they had no idea how to navigate the supply chain problems. The higher shipping prices that are benefiting companies like Zim are hurting companies like Aterian, just demolished them. They missed revenue by a large margin. They pulled guidance for the year. I have no idea what they're going to do in revenues for this year. And I think to top it all off, the final kick in the face was the $40 million that they raised in a stock offering. Where was it? So, yeah, right here. So stock came down to 12, which at the time looked oversold, rallied back to 20, and then we got kicked in the face with a stock offering at $15. And I convinced myself that the only way that they'd be stupid enough to do a stock offering at $15 was if they had a really good M&A opportunity, or they were building up the balance sheet with cash so that they could get a larger, cheaper credit facility. Because that was really the genesis of my entire investment thesis, was based on doing more accretive M&A. And the only way you can do that is by having more cash available, unless your stock price is high, and then you can use stock to do it. But once your stock falls, like it has with Aterian, doing deals with stock is more expensive than doing it with debt. So, right now their credit facility was at 8% plus warrants. Getting a cheaper credit facility in the 4, 5, 6% range would have made a lot of sense. They could have retired the old debt. And unfortunately, we found out in Q2 earnings that it was none of that. That debt, that stock offering was only to pay back the current lender because they broke the covenants on their debt facility. So it just, absolute freaking train wreck, Q2. I'm pissed at myself for ignoring some red flags. I'm furious with management in how they hid, like very, very non-transparent. After they did the stock offering, they really went MIA for a couple months. I tried reaching out to investor relations. I never heard back from them. And if you're going to miss earnings that bad, you should probably pull guidance sooner rather than later, or at least announce something to the effect that, Q2, we're really running into some problems. We're probably not going to hit our numbers. We had to do this stock offering for XYZ reasons, something. Like, they just went dark on shareholders and really, really kicked us in the face. So I sold my stock at 525 on average. I took $100,000 loss on this. So I will never forget this. I will be forever scarred by this company. I will probably forever hate this company for misleading shareholders and for management doing such a horrible job at managing Q2 expectations, the balance sheet, just so many problems. So I don't know. It's hard to know what else to say other than I screwed up, management screwed up. I mean, there are analysts. I mean, Brian, I forget his last name, but the analyst from Oppenheimer, even when the stock was falling all the way under 20, I believe he still had a price target of 50 on the stock. And he reiterated it multiple times. So, even the analysts that have followed this company for many, many years and know the industry, or supposed to know the industry really well, and supposed to understand these business models inside and out, and supposedly have access to management whenever they need it, even those guys were really, really wrong on this company. So it just sucks. I feel like this one, not only did it put me into a really deep dark 2 week, maybe not two, well, yeah, probably 2 weeks. I got a lot of hate for this one because I was bullish on it for what I thought were the right reasons, and it did not work out. Now, anyone that had their entire portfolio in this one stock and lost a bunch of money and then wants to come blame me needs to check themselves, because never did I recommend putting your entire portfolio into any stock, never mind this stock. I own 20 to 30 stocks for a reason. They are, position sizes anywhere from 1% to 20%, based on my conviction, the strength of the company, the upside that I see over the next 6 to 12 months. So there are many different reasons or many different factors involved with how I size up my portfolio and size up different positions. Atarian was a large single-digit percentage position, which is how I lost over $100,000 on it. But it was not all of my portfolio. So I understand people lost money on this. I understand a lot of people blame me for this. That's fine. I can take it. But I just think if you bought at the top and you kept on buying all the way down, and then you want to blame me, that's ridiculous. That's irresponsible for you. You need to take some blame. You need to take some responsibility for mismanaging your portfolio. Obviously, I got bamboozled by management, but so did you. We all did. We all believed in the story. We all we all had our reasons for owning this company. We thought that, Amy was worth something, that M&A was going to be successful, that we'd see more product launches. Amazon's a behemoth. So obviously, being a large FBA partner on Amazon, there was a lot of reasons to be bullish on the company. And unfortunately, it did not work out. And that happens. You can't, if you're going to own 25 or 30 companies, you can't expect to make money on all of them. Now, if you want to buy at these levels and hope for a rebound, God bless you. I'm not doing that. If you think that the supply chain problems are going to resolve themselves the next 6 months, in which case Atarian is probably oversold, go for it. buy the stock, buy some options, do whatever you think is right. I'm not going to play that game. I have lost confidence in the management team. I have no idea what the balance sheet is going to look like in 6 months. I have no idea what the supply chain problems are going to look like. I have no idea if they can do any more M&A. I have no idea if they can get a new credit facility. Just all of that stuff is unknown to me right now. And for those reasons, I have no desire to own this company. So it sucks. It sucks taking a loss on a position that you were really bullish on, and just to get bent over by management and, feel like they really did us dirty. And while we were buying the stock on the way down, I think some of them were selling the stock on the way down. And I know that happens. I mean, management always has different reasons for selling. Sometimes it's to pay taxes. Maybe it's to put money in a trust for their kids. I mean, there's a lot of reasons. I don't expect management to hold their stock forever and ever, but this was just a bad, dirty situation where I felt like management on the way down, they should have been buying their stock instead of selling it. Now I know that management did implement some sort of a lockup, self-imposed lockup on shares through this year, which unfortunately gave me a little bit of confidence that maybe things were about to turn around. So once again, I thought Q2 might be disappointing. I didn't expect the massive failure that they gave us. So that's pretty much all I can say on that one, as the stock's up 50% today. Go figure. Crazy. Oh my God. I mean, this has just been a wild year of big winners and big losers. A lot of stocks that are down 50, 60, 70% from their highs. And I just think that we need to look back and identify some of our mistakes and our failures, and what red flags did we miss, and how do we use these mistakes to be better investors in the future. Aterian definitely taught me some lessons, expensive lessons, and I think, or at least I hope, I'm a better investor in the future because of this. One of a couple lessons that I am definitely using now is I am definitely more aggressive with my stop losses, and I'm definitely more aggressive in dumping stocks once major moving averages are violated, meaning, once a stock breaks below a 200-day moving average, it usually means you are in a downtrend, and it's much better to get out of that stock, even if it means taking a loss and waiting for that stock to free fall or do whatever it has to do, and, find some support, build a base, and start climbing. And maybe once that happens, then you can look to get back into the stock. But, I think most of us would benefit from having some better risk management in place, whether it's, you own some put options, you use stop losses. I'm not a big short guy, so I don't short any stocks, but I think for me, it's, if you're buying a stock above a trend line or above a major moving average, then you should be setting up a stop loss below that trend line, like I showed you with Roku, or below that moving average. So if things break down and the technicals suddenly look ugly, you can get out with minimal damage, rather than, bag holding and, or just, you keep adding to a loser on the way down, dollar cost averaging down to lower your cost basis, when in fact, all you're doing is just adding to a crappy company, when you should have cut your losses sooner and taken that capital and added to your higher quality company. So, if you look at this chart on Aterian, 200-day moving averages, it's not 100% accurate right now, but I mean, if we look back on, maybe where these 200-day moving averages might have been, a few months ago, before the real damage was done, maybe we would have gotten out maybe I could have gotten out in the 20s, mid 20s, and waited for a better setup. Now, maybe I would have gotten sucked in here and then gotten screwed anyways, but, or maybe I would have gotten out at 20 and realized that this company was not worth owning, and just stayed away from it and not gotten, not felt this pain. So, I probably would have lost money on this stock no matter what, but I probably could have reduced my losses to, maybe 40 or 50,000 instead of over 100,000. And that's something that I'll just have to live with and, accept responsibility for my part of this failure. But at the end of the day, I'm not running this company. I was not the one that was misleading investors. I was not the one that was unable to manage the supply chain problem or unable to get this credit facility that they kept promising us. So a lot of the pieces of that story, I have nothing to do with. Now, I was obviously wrong in my investment thesis because those pieces never came together the way that I thought they would. Let's see. I think that's pretty much it. We've gone 3 hours. I can't believe people are actually still watching. Yeah, I'll wrap it up there. I think I touched on most of the companies that I want to talk about, most of my portfolio. So if anyone has any questions, you know where to find me on Twitter or my email address, jonah@luptoncapital.com. And I do try to get back to everyone if I can. And then one last thing, I would recommend joining my StockTwits room. I do think that I'm able to drive much more value on StockTwits than I am on Substack because I post in my StockTwits room anywhere from 10 to 20 times per day. And there's other people that are also posting in my StockTwits room. So there's like 15 or 1,600 members in there, I think. But I post a lot of so you can see, like I post a lot of charts in here. I post my portfolio. I haven't been very active today because I've been on this webinar, but if you scroll back the last few days, you'll see where I post my portfolio, any links to videos or research that I'm reading. So I'm very active in there, much more active in there than I am on Substack or even Twitter. So if it's $10 a month to join the room, and I'm doing a 10-day free trial. So you can be in there for 10 days for free. If you like it, great. You can stay in there. If you don't like it, you can cancel, and you don't end up paying anything. So if you're still watching this or you watch this webinar later and you want to join, you can go to, so it's, if you go to stocktwits.com, stocktwits.jonahlupton.com, it forwards to my room. So I hope that helps. Thanks for watching, and I will try to get my next Substack write-up out in the next week or two. If I can think of a company that I want to write about, most likely it's going to be one of these that I haven't written about yet. So, okay. See you guys later.